High probability price action trading. Welcome, and thank you for purchasing this high probability price action trading video course. I'm sure you'll enjoy it, you'll learn a lot, and it will certainly help you with daily trading. Whether you're a new trader or a seasonal trader, it will help you with all aspects, and you're able to incorporate this into your current trading plan. In a nutshell, price action to me is just the language of the market as it moves about. To understand the market, you have to understand the language. What good is it if the market is telling us one thing but we do another? Well, believe it or not, many of us do exactly that. The market will be saying bearish, but we will go long and then wonder why we lost our trade. Learning a new language takes time, and you must learn to listen before you can speak. Every language sounds strange the first time you hear it, but the more you expose yourself to it, the more familiar it becomes, and the easier it is to speak it properly. This is also true with the market language, and I'm going to teach you how to listen and read the markets to help you to better understand where, when, and why you should or should not be entering a trade. To learn the market language, we must first learn our ABCs, and that comes in the form of candlesticks. The candlesticks are the ABCs of the market. A candlestick chart gives a clear indication of the intraday price action. Whatever time frame you work on, candlesticks can be an incredibly powerful trading tool for helping us to understand the market language. The patterns listed are patterns that I feel have the highest probability of success. Introduction to candlesticks. The Japanese are credited for developing the candlestick technique still in use today. These techniques originated in the technical charting methods used as far back as the 1600s. Japanese candlestick charts were drawing their charts on a scroll of rice paper from right to left with a crow quill and India ink ground by hand. Munehisa Homa, a rice merchant from Sakata, Japan, who traded in the Jijoma rice market, is considered to be the father of the candlestick chart. He was also called the God of the Markets because he was the most successful trader of that era. In 1989, in Futures magazine, Steve Neeson published his first article about candlestick analysis. He is known as the pioneer of candlestick charting outside of Japan. He authored the first U.S. book about candlesticks called Japanese Candlestick Charting Techniques, and also wrote the Candlestick Course. Understanding the candlestick formations help you to spell out market forces and investor psychology. One reason that the candlestick charting technique have become very popular among traders today is that it accurately reflects short-term market sentiment. Candlestick charting allows a quick read on changes in supply and demand. By analyzing the daily price movements of an asset using candlesticks, a trader is able to confirm evidence of a possible trend reversal very early on. Candlesticks draw an inductive as opposed to deductive view of the markets. The facts are presented graphically. One has only to read and understand. The body of the candlestick chart is known as the real body and represents the range between the open and closing prices. A green body represents that the close during that time period was higher than the open, which makes this a bullish candle. From this, we know that the bulls had control of the market during this session. The lines above and below the real body are known as the upper and lower shadows, representing the high and low price limits for the period. Here we can see that the real body is red. A red body represents that the close during that time period was lower than the open, which makes this a bearish candle. From this, we know that the bears had control of the market during this session. Spinning tops are candlestick lines that have small real bodies with upper and lower shadows that are of greater length than the body's length. This represents indecision and consolidation in the market, as the market is at a short-term state of equilibrium. The color of the body of a spinning top, along with the actual size of the shadows, is not important. The small body relative to the shadow is what makes the spinning top. The tweezer top is a moderately reliable, bearish, reversal candlestick formation, consisting of two candles that are generally seen at the end of an uptrend. The first candlestick in the pattern is a rising bull candle, while the second candlestick is a declining bear candle. The tweezer top generally establishes a line of resistance at the high point of a weakening uptrend and is often an indication that the market is headed lower. Any two candlesticks can be tweezer tops as long as the second candle, open and close, remains inside of the previous candle, open and close. The tweezer bottom formation is viewed as a bullish reversal pattern seen at the bottom of a downtrend. The pattern consists of at least two candles, but could be more. The first candle is a bearish candle, and the second candle is a bullish candle. Any two candlesticks can be tweezer bottoms as long as the second candle open and close remains inside of the previous candle open and close. This forms a minor support level at or below the lows of the pattern. Tweezer tops and bottoms are a form of some other reversal pattern, as you will see. Psychology behind the doji. The psychology behind the doji represents a market that is indecisive or exhausted. The market is at an equilibrium between supply and demand, whereas neither the bulls nor bears are taking control. Dojis are found in both an uptrend or a downtrend and can serve as a warning of impending trend change, especially at support and resistance levels. A doji occurs when the open and close for that session are the same, or certainly very close to being the same. The lengths of the shadows can vary. The perfect doji has the same opening and closing price. A doji preceded by a bearish candle in an uptrend would be meaningful. This particular combination of candles is referred to as a bearish doji star and would be cause for concern. A doji indicates tightening of price activity. As price activity tightens, the potential for a reversal or breakout becomes more probable. When dojis form in groups, more pressure is created. Thus, we have a high probability of a major reversal or breakout. In a defined, longer-termed trend, it is not uncommon to see 4 or 5 dojis in a group that form near correction points. Dojis represent the market tug of war between bulls and bears, whereas at the end of that session, no one won the battle, and the market closed pretty much where it started. A reversal is possible due to the fact that if the dominant trend were still in control, there wouldn't have been a tug of war for control, and there would have been a clear winner. Long-legged doji. The long-legged doji has upper and lower shadows in the middle of the session trading range, reflecting that price traded far from their opening and closing points, only to return back with no momentum or decision by either the bulls or the bears. In a trending market, it represents the indecision for the future direction of the trend. If a long-legged doji occurs during a strong uptrend or downtrend, it can mean a possible reversal of the current trend. Gravestone doji. The gravestone doji shows price action that opened and closed at or near the bottom of its current range, giving the bears the upper hand for the session, and can be considered very bearish at a top. If the upper shadow is quite long, it means that the gravestone doji is much more bearish. prices open and trade higher, all session prices open and trade higher, all sessions only to close where they opened. This indicates that the bears overcame the rally by the bulls, and it is a serious warning signal if it follows an uptrend. The reliability of this signal depends on the length of the upper shadow. The longer it is, the higher the probability for a trend reversal. Dragonfly Doji. The Dragonfly Doji is a single candlestick bullish reversal pattern that indicates possible trend change or reversal of the existing downtrend. The Dragonfly Doji forms when the open and close are at the high end of the session, indicating that the bulls have rejected the down move by the bears. The longer the lower shadow, the more bullish the signal. Dragonfly patterns work best as bullish trend reversals at support levels. Reversal candles. Reversal candles are candles or candle patterns that signal a possible price reversal. The patterns represent an exhaustion, consolidation, or loss of momentum that occurs after a significant bull or bearish trend. During a trend, there are two main moves that take place. Those moves are impulses and corrections. Impulses are moves in the direction of the main primary trend. Corrections are counter to the main trend, meaning they are counter-trend moves. Our objective will be to trade the impulse moves or trade with the trend at a reversal of the correction. To follow a trend, you must identify the trend. There are many ways to follow or identify the trend direction, and we will learn more about this when we cover fractals, as the trend begins and ends with a fractal. Reversal candles. The diagram below represents a bullish trend. The white lines are impulse waves following the main direction of the trend, and the black lines represent corrections going against the trend or counter end. When we look for reversal candles, we want to look for those reversals at the end of the correction, where the black lines end and the new white line starts. How will we know when those corrections are ending, you ask? Well, we will use reversal candles, support and resistance, and fractals. The up is the impulse wave. Down is the correction. Again, you go up, there's the impulse wave, and down, the correction. The impulse wave goes up. And at the bottom of the correction, look for reversal. Here you can see the main trend is now a bearish trend to the downside. Since the trend is down, then the impulse waves are also down, which means now the corrections are up or bullish. In this case, we now want to trade to the downside at the end of the bull correction. Down is the impulse wave, and there's the correction going up. Again, down for the impulse wave, and up is the correction. Down, impulse wave. And at the top of the correction this time, we'll look for the reversal. Hammer. The hammer is considered as a bullish reversal pattern forming at the bottom of a downtrend. The hammer is made of a single candlestick line. It consists of a long lower shadow and a small real body that are at or very near the top of their session's trading range. The bulls defeat the decline of the bears and rally the price back up near the top of the session's range. The failure of the market to continue the sell-off reduces the bearish sentiment and forces traders to abandon their short positions. If the close is above the open, causing a green body, the bullish sentiment is even stronger. The hammer may have no upper shadow or a very small one, enforcing bullish implications. This clearly shows that the bears have lost control. The main characteristic of the hammer is that the lower shadow should be at least 2 or 3 times the height of the body. A long wick at the bottom of the hammer candle indicating how much selling pressure was present. Hammer aggressive trade entry. Here is an example of a hammer aggressive trade entry, setting a pending order to enter long a few pips above the hammer high with a stop loss below the hammer low. The aggressive entry will usually limit your risk as your stop loss distance will normally be smaller, but the probability will not be as high due to the fact that the reversal has not been confirmed. Hammer conservative entry. Here is an example of a hammer conservative trade entry entering long on the first candle that closes above the hammer high. The conservative entry will usually increase your risk pip-wise as your stop loss distance will normally be larger, but the probability for success will increase due to the fact that the reversal has been confirmed with a close above a previous high level. Shown above are the results of a successful hammer trade as the price reverses and goes in our favor. Shooting star. The shooting star is considered as a bearish reversal pattern forming at the top of an uptrend. This pattern indicates that the market is rejecting a higher high. A close on the next day below the shooting star close can give a good confirmation of a possible top reversal. The shooting star candlestick pattern forms when the bulls rally the price only to see the bears reject the rally and the price falls and closes near the low. The pattern reflects selling interest at a supply level. When the pattern forms in an uptrend, it suggests a possible market top or change in trend. Shooting star is an uptrend rejecting higher prices. Shooting star aggressive entry. Here is an example of a shooting star aggressive trade entry, setting a pending order to enter short a few pips below the shooting star low with a stop loss above the shooting star high. The aggressive entry will usually limit your risk as your stop loss distance will normally be smaller, but the probability will not be as high due to the fact that the reversal has not been confirmed. Here is an example of a shooting star conservative trade entry entering short on the first candle that closes below the shooting star low. The conservative entry will usually increase your risk pip-wise as your stop loss distance will normally be larger, but the probability for success will increase due to the fact that the reversal has been confirmed with the close below a previous low level. Let's take a look at the hammer and shooting star in context.
Okay, so before we get started here, let me show you a live trade that I'm in right now. And basically I use the techniques that I'm getting ready to show you about. Here we had a rejection candle. I mean, you can call it a hammer or whatever you want, but it's not quite a hammer because the open and close are too close to each other, so I really wouldn't call it a hammer. But what's most important about that hammer is not that body, it's that rejection that's the main thing. And that's what you have here on this candle. So when we're looking at these candles, we're really concerned about that rejection, how big that rejection is. So we get to a point where we see the market bounce off of support and resistance and reject those levels, and you see buying pressure coming to the market and so forth. But here we see the market was in a downtrend, so we had a nice downtrend, and then we had a fractal level here. The market broke the fractal level, came back and bounced on that fractal level. That same fractal level is going to be important for us for a little while. So the market drops to a low down here, and then the market shows me some structure that probably leads me to believe that we're having a change in direction of this previous trend to a new trend to the upside because we violated this fractal level here. Before we honored this level, and then we flew right through this level, and then we used this level to trade off. The market came pretty much back to that level pretty close, and then violated that level and moved to the upside. So as I start showing you how I'm trading these rejection candles and shooting stars, hammers, all that, you're going to realize how we do this, and it's pretty basic. But I have an entry above this level here and my stop loss below this point. All I'm waiting for was this candle to close and see the bounce off of this level here. Now, if support and resistance, the market doesn't come exactly to the point sometime. It's a little, a little off the base, because support and resistance is not a line here. It's not this line, it's an area. So that area can be between, 10, 20, 30 pips of an area, or even more. So with that, this is the daily time frame, and I moved my stop loss down a little because we had some news come in, and I wanted to make sure that I had a good technical level. And a lot of times, even news with technical trading honors some of these levels, so I wanted to be careful there. But you can see I'm made some nice profit right now, and I'm going to let this thing run because it seems like it may be the beginning of a trend. So what I looked at was, like I said, you see that downward movement here. That was a change of direction right here, and it starts and ends with a fractal. So this new trend ended with a fractal. The old trend ended with this fractal, and a new trend started with this fractal. So fractals are very important, okay? And then with that, I looked at a pattern called a 1, 2, 3 pattern. We're at the 2 position right now. I'm not going to get deep into the 1, 2, 3 right now because we're going to cover that later. But we're at this position. We need to violate this level and move higher. If we can't violate this fractal here, then we're going to see the market drop back down to the downside, because we already had change of structure here, but this will continue with change of structure here. This is really the main one because of the pullback and the amount of angulation on here. I want to see a nice break above this level, and this will probably set this off for a nice run to the upside. All right, so let's get into looking at some of these patterns. We'll go over the hammer and shooting star, and then we'll start to look at some other price action entries using reversal candles. All right, so let's get going with it. All right, so we're going to look at the candlestick patterns in a market environment and look at how to trade them, and show you some details about trading them in a conservative and an aggressive way. And also I'm going to show you how to trade rejections. Basically, the candlestick rejections will be pretty much like your hammer, your shooting star. I'm going to show you how to trade those rejections zone trading. So pretty much those rejections with the long wicks, we're going to trade those as a zone. So we have another way to trade them and pretty much limit our risk and still have a high probability trade opportunity. So we want to first start off looking at the hammer. So the hammer is going to be the first thing that we look at. So let's look for the hammer and see what we're going to do about trading it. So you see the market's moving up. We were looking for the market to come up to this point, this next resistance level, but the market failed so far. So we'll see where the market goes. And we're going to trade these support and resistance levels pretty much right now. That's what we'll be looking for here. Okay, so now you could see this level here. This is our support level, and then we had this big candle. This is a hammer that hit off of this level. But the thing about this, I do not want to trade a hammer that's this long with the wick this long. I mean, I do love the wick that long, but the problem is I want that wick when it ends, I want the support and resistance level to be right there. So I like the support and resistance level to be there, because therefore, other than that, if I'm not trading it at this level, then I have all this risk that I have to worry about pretty much, because the market can move from here all the way back. Matter of fact, it closed here, so we can move all the way down to this point, at least to this support level again, and probably take me out. So I would be less inclined to trade that candle there. All right, so we'll let the market move a little more and see if we could get tighter and get a better trading opportunity here. Okay, so it did close as a nice hammer here. Now that's a really great hammer. That's what you would be looking for, but just you don't want to be that far from the support and resistance level. When we're trading, we want to try to be as close to a support or a resistance as possible. So I say try to be as close to the floor or as close to the ceiling as possible, and that will help you to limit some of your risk. Okay, so waiting to see what price is going to do here. Okay, so now we hit this support level. So now we want to see what's going to develop here. So you could see the little bit of rejection here, which is going to be considered some buying pressure. That's where we have some buying pressure. And you can see the market dropping even a little bit lower. Waiting on this candle to close, and then that candle closed. That candle closed as a hammer. This is the rejection we see. This is where we see the buying pressure coming into the market. So here we see this was all bearish. So we're looking for a reversal at the support and resistance level. So the bears were in control of this market, but you could see a lot of bullish momentum here where there was a lot of buying pressure in this area. Then the market dropped, and then now we still see where we are at the support and resistance level. So the way that we want to trade these, pretty much the way that we look to trade these, I'm going to show you what I'm going to be looking for. All right, so the aggressive entry is going to be pretty much like this. We're pretty much looking right here, and soon as the candle hits this level right there, that's where I will put my entry. So I'm going to make my entry line green. We'll make that a green line. And we'll make it a little bit thicker. And then we'll make our stop loss line red. So our stop loss should be a little bit below this wick of this candle. So we'll make that a red line also. That's a red line. Okay, so now my aggressive entry is going to be soon as this level is hit. So soon as this candle closed as is, I put a pending order for a trade to the upside here. All right, so with that trade to the upside here, right at this level, let's see what the market does. So I would have been triggered in right here. My trade is triggered. My stop loss is way down here. And then now we're waiting for this candle to close to see what we get here. Okay, so this is one thing. This is a couple things that I want to talk about. First of all, when you set a pending order on these candles and you have price move higher and then pull back to the level and close, this is an aggressive entry because you're not really confirming that this level has been violated. You want that level to be violated. If it's not violated, well, then the market comes back inside here and doesn't close below that level. All right, I mean, it doesn't close above that level. When we close above that level, that kind of confirms the reversal for us, and that's what we really want. So let's continue. Okay, so pretty much we'd be sitting in a losing trade, right? And then now As I said, that was our aggressive entry, right? But my mentality is still the reversal here because we never closed below this wick of the candle. If we close below that wick of that hammer, then my mentality changes. I'm not looking for that reversal anymore. All right, so I showed you the aggressive entry and we would have been triggered, and now we're still in a winning trade because price never came down to this level here and took us out, took our stop loss out. But now this candle closed, that really confirmed that this level has been violated. So this is where we would enter the market, being pretty much being a conservative entry. So we'll move our entry to there, our stop loss to there. Now what that does, there's two things. One thing is, first of all, you could see at this level, if we would have entered the market here, we have less risk because our stop loss is down here. But then if we enter here, here's where our stop loss is, way down here. All right, so it's a bigger risk. But now we can also move our stop loss based off of two things. Number one, when we enter the market, we can move our stop loss to a conservative level or an aggressive level. So the conservative level is where we are right now. This would be our conservative stop loss level below that wick. If we want to be a little bit more aggressive, we can move it up here. All right, and even with the aggressive entry, we could have moved our stop loss up to the candle that violated. All right, but you see, we would have been taken out. All right, so I like to keep my stop loss here and make sure that we get a close above that level. Now this close here, we can move our stop loss here, but don't forget the market still could come back to this level here. All right, so this is where you would enter the market on a conservative entry. So remember, our aggressive entry is right at the wick of the candle, and the conservative entry was right here. All right, so I also want to take you back and look at a couple other things. All right, so now I'm going to show you how to trade this as a zone. Okay, so the market is going to continue moving. I'm going to slow it down because I want to show you and be able to talk about this. All right, so we're going to let this move and we're going to follow the price. So our entry is always at least here starting out. So we're going to start with a possible entry here. That's our goal, to enter right here, a little bit above that wick of this hammer here. All right, but now we're going to trade this as a zone. Okay, and I'm going to show you exactly what I'm talking about. Between this open here and this low here of this hammer, that is a support and resistance zone, pretty much a demand level, pretty much where you see a lot of buying pressure coming into the market. So we know that it's a strong level, quite possibly, because that's where the bulls were able to take control and push this higher. So if price did come back this way, we know that there's a possibility that the price here, as it comes down, could probably get pushed back up. So what I want to show you guys, I always start out with an entry here. If the price goes lower than the body here, then I'm going to move my entry down to the body. So watch. So currently I'm not going to move my stop loss. I mean, not my stop loss, but my entry. I'm not going to move my entry. And we'll wait to see what goes on. And then you could see what happened. The market moved down here. The market moved all the way down here. So when I see the market move down here, I'm going to move my entry here. All right, so now I cut some of my risk. All right, so I move my entry here. If the market decided to go, let's mark it down. If the market decided to go here, I can move my entry down to here somewhere. The philosophy is that we want the market to come up to us and trigger us. All right, the market's below us, so we want the market to start moving higher and come to us and put us into the trade. All right, so where the market is right now, we'll go by that. All right, so now instead of having my entry up here, and this is a pending order, I can now move my pending order to this point. right to the body there. And the farther down that this candle goes, the farther down I can move my entry, limiting a bunch of risk. All right, but still having that same probability for a good trade. So now you see where my entry is, so let's get the trade going. So we'll move the trade a little bit faster now. We already see where we are. We got triggered. We're into the trade. Boom. All right, so yep, there we go. The market's moving. And you can see now, where am I going to look to take profit? The first thing I'm going to do, I always look to my left because I'm going to take profit at support and resistance levels. All right, so the first level I'm going to look to take profit is here. So we'll make this a green line because that's going to be profit. So with that, I'm taking profit at that level, or else what I do, I don't usually take profit depending on how many lots I'm using. You know, if I'm trading 8 lots, then maybe I can take 4 off and let 4 run. But the other thing that I like to do is I like to wait to see what the market does when it gets to my support or my resistance level where I plan. So this is my first level that I'm worrying about, to see if the market can get through that level. And the market got through that level. So what I like to do, guys, is pay attention to each candle, because each candle is going to tell me a story. But the thing that I like to do is stay 2 candles behind the market. So what that is when the market is here, all right, so the market was here, I want to be 2 candles behind it. So I'll be 2 candles back would put me here with my stop loss still where it was. All right, so when the market moved here, and where it is pretty much now right here, I'm going to be 2 candles back, 1, 2 to the low. So that's where my stop loss is going to be. All right, and now 2 candles back from here would be 1, 2. It would put me here, so I can put my stop loss there, a little bit below that level. And then I want to see if the market's going to violate this point, because if it does, then my next level, where am I looking for another target? To the next support and resistance level. That would be right up here. That's where I would look for my next target. So we already got through the first level here, and let's see what the market's going to do. And now when I see this candle, this candle here tells me a little story, because this is going to be our next candle that we talk about, which is going to be a shooting star. All right, so when I see that shooting star, I probably get pretty cautious, and I probably move up, right up under that level, because that signifies a possible reversal. And I may not have gotten taken out yet because I'm a little bit below that level. And the market continues to go higher. And the thing that I always want to mention, guys, when we look at these reversal levels, we want them to be at support and resistance levels. So when I see this shooting star here, more than likely this was my level right here where I had support and resistance. So I can bring my stop loss to that level at least, because it's pretty close to where that shooting star was. So now that's where my stop loss would be. All right, and I really like to stay 2 candles back. I would have been here, but since I got a signal like this, I decided to move right up to the support and resistance level. So now the market's moving here. I'm going to stay 2 candles behind. So 2 candles behind is going to put me right here. I'm right here, a little bit above the support and resistance level here. The market moving, attacking our next level. Let's see if we could get to that point. And it looks like we would have got triggered right here. It looks like we were out of the market. So that's it. That's where we would have probably taken our profit, because we stayed 2 candles behind. Here we got hit that triggered our stop loss, so we would have been out of the market pretty much. And actually, this is my stop loss level, so I still wouldn't have been out, but 2 candles back would have put me up here. So I'm going to be here, and I know at least I'm going to take profit at this point. And then now, seeing all this indecision here and rejection of this level, the market not quite hitting my support and resistance level, let's see what happens. Now we're triggered, we're out. This is where we would have gotten out of the trade. This is where we would have got stopped out. So we lose some of this profit here, but when you see these reversal signals, maybe you want to tighten up your stop loss. All right, so that's how to trade the hammer. I showed you the conservative entry, I showed you the aggressive entry, and then I showed you how to trade it as a zone. Don't worry about that zone right yet, because you're going to learn more about that as we trade with the support and resistance levels. You're going to learn a lot more how to trade a zone trade, okay? So that's it for this. Let's go to look at a shooting star trade and see how we would enter the market. Pretty much the same way as we would enter the market with the hammer, but just upside down. Same thing with the zone and everything else. So let's have a look at it so you guys can understand what I'm talking about and what I mean. All right, so now we are going to look at trading the shooting star, and that's going to be a reversal of a bullish trend to a bearish trend, or it could be a correction or whatever. But now if you remember, when we talked about the market and we talked about impulse and corrections, I'm going to show you we want to be trading in the direction of the trend. So currently it looks like the direction of the trend is this way. So we're going to follow the trend because it looks like the direction of the trend is this way. So we'll mark those waves that we talked about, which would be, this would be a move down, which would be my impulse wave. And then this would be the correction, pretty much. And then this would probably be more of a impulse wave. So let's let it finish and see where we are. We're going to be trading in the direction of the trend. So we want to trade to the downside, as you can see, pretty much the downside. And we'll learn more about the trend and everything else, the main way that I follow the trend and follow the direction of the market when we talk about market structure. We're just doing a quick show here. So I'm going to delete this trend line, and then I'm going to mark this level here. All right, so this is the impulse wave. This is the correction. At this correction, we want to be trading to the downside. All right, so here we would have been looking for maybe, like as I'm saying, the shooting star, or one of the reversal candles that we would look for to trade from a bullish trend to a bearish trend. All right, because this isn't really the trend, but this is the move to the upside. Now we want to reverse and go back to the downside, which would keep us in line with the overall trend. So let's let the market move a little more and see where everything is. So we could see the market still moving to the downside. And then we're coming up back on this support and resistance level. So now we hit that level, and let's see what we got there. Okay, so now this is our shooting star here. It has a little bit of a wick on it. I'd rather see a little bit less of a wick, but still I consider this a shooting star. So we're going to back it up a little bit here and talk about this shooting star and show you the context of this whole thing. So if this, we're following this trend here, if this is an impulse move, then a correction, then we'll call this whole move the impulse move. So that would be here. All right, and then quite possibly the correction would be here. So we would say this was the correction, right? So if that's the correction, then now we want to look for a trade in this area where the support and resistance level is. So now we would be looking at this resistance level to trade to the downside. So at this resistance level, we got what we wanted. We got a shooting star. So with that shooting star, this is going to be my stop loss starting right off the bat. I know where my stop loss is right off the bat. This is a technical stop loss based off of knowing that the previous high, this is the previous high and the most relevant high. We're going to put a stop loss there. When we look to enter the market based off of what we already see, we're going to put our entry right below this level here. So we would be a little bit below that level. And I'll make my entry green. So that would be our entry here. All right. Now, remember, as I told you, as the candles move higher into this wick, I can move my entry higher. All right. So let's look where we're going to trade now. And then I also know where my first target level is. It's not really my target level. I call these target levels, but this is where I'm looking. Basically, it is a target level. It's not a take profit level. That's my target level. I want to see if the market could get there. And then I'll decide if I want to take profit based on the price action that I see at this level. So we have our shooting star developed here. And now we're going to trade. So we'll let the market go now. And now you can see this candle moved up into the body here. So I'm going to move my entry from here up to this point right now. At least to that point. All right, and the higher this goes, if this candle goes way up here, I can move my entry up to here. This is limiting some of my risk, that stop loss risk. All right. So let's watch the market again. Now look how high this candle got into the wick of this candle here. So I can move my entry higher. I can move it way higher. All right, so I can move my entry here. Look at what I eliminated, all of this, and now that's only my risk. And my probability for a high trade is still the same. All right, so I traded inside of this wick. All right, so this is pretty much zone trading. I'm going to show you that on support and resistance trading also. So let's let this go a little bit more. And see, we want the market to come back down to us and trigger us. We don't want the market running up and trigger us and then have to wait for the market to turn back around and come to the downside. So let's see what's going on here. So it looks like we pretty much would have gotten triggered around there. And yes, we would have gotten triggered. And then the trade progresses. Looks like the bulls don't want to give this up. But you can see what happens. The market's starting to fall. Looks like the bears are starting to take control. So there they go. And now again, my first target that I'm going to look to take profit is right here. And then I like to stay 2 candles behind. That's a way that I teach people to trade a stop loss. But my main things are I follow fractals. So when we get on fractals, I'll teach you more about those stop losses. And those stop losses are usually quite big, much bigger. All right. So you have to figure out the best way for you to take profit. And my way is looking at the next support and resistance level, then looking at what the market does at that level. All right. So we could see this is my level where I'm going to see what the market's going to do here, and then I'm going to decide what I'm going to do. And it looks like we're getting rejection here pretty close to this level. But we still have a little way to go. The candle has to close, and then we're coming through. We come through that level. I like this. So here's what I'm going to do now. Since we violated this point, let's see how we close. So that's a nice big close below that level. Now the thing is, you had a major candle like this. You don't want to lose all of this profit because staying 2 candles behind keeps us way up here after the big major move. And this probably was done with news more than likely. So what I'm going to do now is I'm going to move my stop loss all the way close to this support and resistance level. And I'll give it a little buffer because now the market could come up, bounce off of this level, and continue to the downside. All right, so we'll see what the market's going to do. And we're trading in the direction of the main trend now. So here's our stop loss. See what happens there. and we get triggered. We're out of the trade. So here's where we would have been out of the trade. We would have made profit from this point down to this point here. Not a bad trade. All right, so that's how you would trade the shooting star. Pretty much the same way that you're going to trade the hammer, and pretty much the way you're going to trade rejections when you see those. So I pretty much call those hammers and shooting stars. I don't call them that. I just call them rejection candles. When I see that rejection at a support and resistance level, that's where I want to be trading. You know, I want to be into the trade. So if I'm looking for a move to the downside, when we're trading to the downside, we want to trade resistance, rejections of resistance, because that means the market's moving to the downside, pulls back, hits resistance, rejects the resistance, and comes back down to the downside. And when we're trading support, we want to be trading long, so we watch the market come down to the support level and reject that level and go higher. All right. So that's the way you really want to be trading when you're trading these rejection candles that we're going to be calling them. All right, so that's it with the shooting star. Next, we're going to look at the inverted hammer.
Inverted hammer. The inverted hammer is considered a bullish reversal pattern forming at the bottom of a downtrend and represents a possible reversal of trend. The inverted hammer is comprised of one candle. It is easy to recognize as it looks like an upside-down hammer. It is formed with a small body with a shadow at least 2 times greater than the body. Found at the bottom of a downtrend, this shows evidence that there is buying pressure coming into the market at this level, but the selling is still dominant. The color of the small body is not important, but a green candle has slightly more bullish implications than the red body. Hanging man. The hanging man is considered a bearish reversal pattern, forming at the top of an uptrend and represents a possible trend reversal. In order for the hanging man to appear, the price action for this session must trade much lower than where it opened, then rally to close near the high. This is what causes the long lower shadow, which shows how the market just might begin a decline. There's no hard and fast rule about what color a hammer or hanging man should be. The fact that they have a short body already means that there's indecision coming into the market. However, a red hanging man is a stronger indication of the possible trend reversal. The psychology behind the hanging man is that when the market closes on the next session below the body of the hanging man, the bulls who bought the open or close of the hanging man, because of the lower wick leading traders to believe the bulls are back in control, will be left hanging. The key factors for a reversal hanging man pattern are a preceding uptrend and a next session close below the hanging man close. Bullish engulfing pattern. The bullish engulfing candlestick pattern is considered as a bullish reversal pattern forming at the bottom of a downtrend. The pattern consists of 2 real bodies of opposite color. The second day's body completely engulfs the prior day's body. The first day of the bullish engulfing pattern has a smaller body than the body of the second, which engulfs the first day range. Because the second day's move is so much more dramatic, it reflects a possible end to the previous trend. The bearish engulfing candlestick pattern is considered as a bearish reversal pattern forming at the top of an uptrend. The pattern consists of 2 real bodies of opposite color. The second day's body completely engulfs the prior day's body. If the second day engulfs the shadow of the first day, the success of the pattern will be much greater. Morning star pattern. The morning star pattern is a possible bullish reversal pattern forming at the bottom of a downtrend. It is made of a long bearish candle followed by a small body indecision candle. The third day is a bull candle that moves into the first candle's body, which is a sign of buying pressure as the bulls enter into the market. This pattern indicates that we may see higher prices. Evening star pattern. The evening star is a bearish reversal pattern that appears at the end of an uptrend. The first day is a long white body followed by an indecision candle. This is the first sign that the current trend is exhausting itself. The third day closes even lower than the indecision candle, therefore completing this pattern. The further the third candle closes into the first candlestick's real body, usually determining a much stronger bearish move. Piercing line pattern. The piercing line pattern is a possible bullish reversal pattern forming at the bottom of a downtrend. It is formed with two candles. The first day is a red candle which supports the downtrend, and the second day is a long green candle which closes above the midpoint of the previous bear candle. The more penetration into the prior day's body, the more likely it will be a successful reversal pattern. Remember that if it closes above the body of the previous day, it is not a piercing pattern, but a bullish engulfing pattern. Dark cloud cover. The dark cloud cover is a two-day bearish reversal pattern that signals a top reversal after an uptrend. The first day is a long green bull candle. The second day closes below the midpoint of the previous bull candle. The greater degree of penetration into the previous day body, the more likely a top reversal will take place. The psychology behind this pattern is that the bulls are in full control but lose control on the second session and no continuation of the rally takes place. 3 inside up. The 3 inside up pattern is a bullish reversal pattern found at the bottom of a downtrend, indicating a possible reversal. Day 1 has a long bearish candle that is going in the same direction as the current bear trend. The second candle opens and closes within the first, and should close at least at the middle of the previous candle's body. The third candle opens where the second candle closed and then closes outside of the first candle. 3 inside down. The 3 inside down pattern is a bearish reversal pattern found at the top of an uptrend, indicating a possible reversal. Day 1 has a long bullish candle that is going in the same direction as the current bull trend. The second candle opens and closes within the first, and should close at least at the middle of the previous candle's body. The third candle opens where the second candle closed and then closes outside of the first candle. What is an outside candle? An outside candle is a candle that engulfs the previous candle, meaning the current candle's high and low are outside the previous candle's high and low. I define this a little different, as an outside candle can also be a candle that closes higher or lower than the previous candle's high or low. These candles are also considered engulfing candles or wide range candles. Here you can see that the current candle high and low are both higher and lower than the previous candle. My main concern is that the candle closes lower than the previous candle open in this case. This is mainly a bearish engulfing candle. The bullish outside candle. The bullish outside candle is formed at the bottom of a downtrend and indicates trend exhaustion and likely reversal of sentiment. Outside candles exhibit a trading range that fully engulfs the previous candle's high and low. The more the outside candle engulfs the previous candle, the stronger the signal. Bullish outside candle bear trap. The bullish outside candle at support is also known as a bear trap. A bear trap occurs when traders attempt to sell a breakout of support as the market falls below the support level and below the low of the previous candle, only to rally back above support and then close above the previous candle high, trapping the short breakout traders. As bulls enter the market, the trapper bears must buy their way out of their losing position, which further fuels the upward price momentum and panic buying for the remaining short sellers who are still in the market. Bearish outside candle. The bearish outside candle is formed at the top of an uptrend and indicates trend exhaustion and likely reversal of sentiment. The bearish outside candle at resistance is also known as a bull trap. Much like a bear trap, the bull trap happens as traders attempt to buy a breakout of resistance as the market presents a false rally, trapping the bullish breakout traders as price tumbles lower, and the longs have no choice but to sell a losing position, hence the bull trap. Outside candle at resistance. Here, you can see an outside bar at the resistance point as the outline candle high and low exceeds the high and low of the previous candle. This is known as a bearish outside bar, as the candle closes below the previous candle low in a downtrend. What is an inside candle? An inside candle is just a candle that is engulfed by the previous candle, meaning the current candle's high and low is inside the previous candle's high and low. If the current candle's high or low are equal to the previous candle high or low, the current candle is still considered an inside candle. Inside candles are also known as a narrow range bar. Here you can see that the green bull candles high and low are contained within the previous bear candle high and low. I also consider a candle to be an inside candle if the current candle open and close is inside the previous candle open and close. Here you can see that on this example, we have the current candle high higher than the previous candle high, but the open does not violate the previous candle close, which normally in Forex it won't unless news or weekend open. If the low of the current candle never closes below the previous candle open, then I would still consider this an inside candle or narrow range candle. Mother candle. The mother candle is pregnant with twins. You can have more than one inside bar trading within the mother candle. As mentioned, the more candles, the stronger the expected breakout. What is inside out trading? Inside trading is when one or more candles are engulfed by one previous candle. This means that one or more candles high and low is inside of one main candle high and low. This main candle consisting of one or more candles trading inside of its high and low, making this main candle the mother bar or mother candle. Even if one or more candles inside the mother bar has candle highs or lows equal to the mother bar high or low, this is still considered the mother bar. Once again, I consider candles that have equal open or closes equal to the mother bar. We are still trading inside the mother bar. Once any candle closes higher or lower than the mother bar, open or close, then we have an inside out trading. There's the mother bar, and closing above the mother bar here represents inside out trading. In reality, we are not truly trading inside out until we close above the mother bar open here. This is considered bullish inside out. Inside out trading. Inside out trading is when a mother bar with candles trading inside the mother bar but then eventually break out. As you see, the third bullish candle breaks out of the mother's body, therefore creating inside out trading. We have bullish and bearish inside out or reversal and continuation inside out trading. On this example, this is a bullish inside out or a reversal inside out as price was in a downtrend and found support and traded inside out. Aggressive inside-out trade entry. The aggressive trade entry for the inside-out trade is with a pending order long at the break of the mother bar high and stop loss at either the candle break low or the mother bar low. Targets are always set for the next support or resistance level. Conservative inside-out trade entry. The conservative trade entry for the inside-out trade is placed on the candle that closes above the mother bar high. Stop loss at either the candle break low or the mother bar low. Targets are always set for the next support or resistance level. Inside candle trading. Here we have an inside trade during an uptrend. We look for the market to continue trading to the upside with a bullish inside out. Price has traded inside the green. Price breaks outside of the mother candle. There you see the aggressive entry. Below that the aggressive stop loss, and underneath the conservative stop loss. And up top there you see the conservative entry. If the price violates to the downside, then we are not triggered and we take the trade off the table. The trade works in your favor here. So what is inside-out trading? Now it's time for some chart time as we look at each pattern in a market situation and help you to understand how to trade each pattern individually. As we progress through each pattern, you will learn the conservative and aggressive trade technique. Also, you will notice the concept of inside-out trading throughout each pattern. This concept is much like the Darvas box trading method, but on a shorter term. After we look at how to trade these patterns and understand the inside-out concept, we will start to focus on the market structure so that we can understand which direction we should be trading. We have only begun to scratch the surface, so follow me as we see these patterns in action.
All right, so we want to take a look at trading the inverted hammer this time. So now we'll look at trading the inverted hammer. You can see the market's in an uptrend here, so we want to be moving to the upside and trading to the upside. You could see the move, and then we kind of paused here, slowed down. All right, and then we're going to look for our next move. All right, so when we're looking at this, you could see since this candle gapped way up like this, we know that we're using daily candles, so this was probably the weekend. You know, pretty much the weekend. We closed out on Friday, then opened up on Sunday here. So we're going to look for a move back to support levels where we can trade with the trend of the market, because again, I'm going to show you really quickly. You can see the trend of the market is to the upside, and if that's the case, then we're going to be looking to trade much like we did last time. We're going to trade, this would be one move, which would be an impulse move. And then this would be a correction. And then again, another impulse move. So let's see where this takes us. And this impulse move is going to probably be about this area here. Matter of fact, it keeps going higher. So we'll move it higher. And then you could see a nice shooting star right there. And then the market dropped to the downside. And remember, with that shooting star price, this closed on a Friday as a shooting star. Wow, that's a big signal on a Friday. Then the market gaps up on Sunday open. Definitely would have had an entry at least here. Stop loss up here. Now it's going to be a bigger stop loss based on how big this wick is, and that's going to be true for most of these reversal candles that we use. The bigger the candle, the bigger the wick, or the bigger the stop loss, and sometimes it's going to take you out of a trade where you're not going to be able to enter a trade. But that would have been your ideal setup there. All right, so now we're going to look to trade the move to the downside here. We want to find where that correction is going to be. So we're sitting here now. We're here. And we could call that a correction right there. Okay, then the market moves higher. So it moves higher to there. And then the market moves back down. So we move down to here. So now at support, this support level, and we got this support based off of this level over here. We got the support from here, and then the market violated, pulled back. And now we want to trade this to the upside because the trend was moving to the upside. We had a correction. Now it looked like you were probably starting to get more moves to the downside based off of the higher highs and lows here. But I use fractals, so we'll talk about that deeper when that comes. So I'm going to delete some of these here. Alright, so now we do know that we want to be trading to the upside, and we got a nice hammer here. Alright, so the way that I trade hammers, there's really two ways, and I don't trade once the level is violated here because this doesn't mean much. And I've seen a lot of hammers. Once you take a hammer trade, I've seen a lot of hammers go sideways for a while. The market goes sideways for a while. So pretty much the market trades inside of that hammer for a good while. Alright, so my thing is this is going to be it here. Now what's also scary to me when I'm looking just at this chart is that this is the low. It's lower than the hammer. I really like that hammer to be the low. So at this level and being that close, I myself will come here, or else I may not take the trade because it'll be a little bit deep. But we're looking at this level here, so this is our hammer. So the trade is already, once you see the candle develop, you know what you want to do right off the bat. So I know I want to trade this level, so I'm going to trade above this level. So that's going to be a pending order for me. And I'm going to make my order green so that you know. And then I'm going to make my stop loss is going to be red. So we'll make another level for the stop loss. My stop loss will be a little bit below the level. We'll make that red. Okay, so that's my stop loss here. This is my entry here. This is going to be an aggressive entry because we're not waiting for anything to close. We're jumping on the trade as soon as it hits this level. All right, so let's see what the market does. If I get a close below that hammer, below the inverted hammer here, I take my pending order off the table and I take everything off. That it no longer is valid for me. All right, I don't want to close below the hammer. And to me, this is a support and resistance zone. So pretty much that would be a zone here because you have these wicks here. And we're going to talk more about that when we talk about support and resistance. Now we're trading inside of this, pretty much inside of this inverted hammer. As I told you, hammers, a lot of times you'll see a lot of sideways movement. That's why I don't trade as soon as it hits goes up into the wick and try to let it trigger me into a trade. And even taking the trade at the trigger here is risky with hammers because, again, I told you that you see a lot of sideways movement. But now that's where our entry level is set. So let's see if we get triggered. And then if we get triggered, we'll be in the trade. And so far, no trigger yet, but we're still inside that hammer. Now we're triggered, okay? So this is the trigger. We're already in the trade now at this level. So I could do a couple things here. I can keep my stop loss there. I'll wait for this candle to close and I can move my stop loss up to this level here. When we trade momentum, basically that's what we're doing because we're trading a reversal. We don't really want to see the market come back and close below a previous low. If the market has momentum, it won't close below a previous low. I'll teach you a little bit more about this, but looking at this, here's the low. the first low, never violated. Here's the next low, never violated. This low here, never violated. This low here, never violated. Another low here, never violated. So the market's not violating these lows and it's violating these highs here. So the market should continue to violate those highs and not these lows. Therefore, I feel safe putting my stop loss up to this level. All right, where the market violated and closes above. If it closes above, I'll move my stop loss there. So still waiting on this candle to close. Okay, and this candle closed. Okay, so we're trading with this momentum, so we don't want to see the market come back to this point. So the aggressive entry got me in right here. The conservative entry is going to get me in right here when the candle closes. So either entry is going to get me in pretty close here. Sometime it's going to be even further. Now you're going to have to decide if you can take a trade that has a stop loss based off of either this level or this level down here. How is that going to affect your risk management as far as your money management? You know, I don't know how much you're risking, but 2% is like max for me. That's where I'm not going to take anything above that's going to have a stop loss that's going to give me more than 2%. So maybe I have to adjust my lots or whatever I have to do. So we're looking at this trade and we could see, let's see what the market does. We moved our stop loss here. This is going to be the more aggressive stop loss. Okay, so we moved it up to the candle that violated or closed above. So we watch the market go. So where's our target, our first target where we want to look for profit? The first support and resistance level, it's going to be right there. We're going to look to our left to see where we want to take where it's going to be our profit or our target. So the market moves, and you can see with momentum we never really come back and violate these lows. So I'm going to show you why I don't mind following the market 2 candles behind. If the market's going to move to the downside or upside, it shouldn't come back and really trigger my low. Now there's going to be a such thing as a bull trap or a bear trap, and we'll get into those later. But you can see what the market's doing. So we're going to move ahead here. We showed where our next level is. So this is where we're looking for profit, or at least to see what the market's going to do at that level. All right, so we stay pretty much 2 candles behind. So 1, 2. My stop loss is now up to this point. All right. And then you can see we came through this level, but we still look a little bit like we have a wick. So this would be a level I'm going to pay attention to. So since it's a level where I already knew I wanted to have it as a target, then more than likely I may probably move my stop loss either here or somewhere up to here. But I'm going to move it here now. And then you can see what the market does. It continues higher. Now it's showing me some rejection to the downside, so maybe I get a little worried. I might move tighter. This is how you just have to manage your trade, but I'm 2 candles behind still. So we let the market go. Now 2 candles behind would bring me even farther up here now. Would bring me up to this level. So we're 2 candles behind. And now we're getting closer, and especially when you see a little doji like this, indecision, you know the market may change, but no, the market continued to the upside. When you see indecision, it doesn't mean that the market's going to change either direction. It means that there's no decision of which way we're going to go until somebody takes control. And here it looks like the bulls took control. And I'm 2 candles behind. And now we could see that. And then I'm 2 candles behind, pretty much still where I was. And then the market's violating this level. I'm going to probably be out right here, because you could see this would be the second candle. So we would be out right here. We'd at least right here where this candle came all the way back, because this would be 2 candles behind. And you can see we had a big bear candle. And this is also an outside candle. And we're going to talk much more about that. And this happens a lot at support and resistance levels, and this would be known as a bull trap. So we'll talk more about that when we get to that point. But that's trading right there. You're looking at trading the inverted hammer. All right. So from here, we're going to go to the hangman. It's the same as the inverted hammer, but it's an upside down trade where we're moving from bullish to bearish. All right. So let's move on with that. All right, so now we want to look at our hangman here. Okay, so looking at a hangman, basically what we're going to be looking for is to trade resistance. Okay, so the market's moving to the downside here, and then we're going to look for a pullback to resistance. This is where we want to get into the trade. We got the resistance based off of these levels over here. So we got support and resistance levels drawn in, and when we're trading, we're also going to be using fractals. So that's going to be another big indicator that we're going to be using. It's not really an indicator per se, but you'll learn more about it as we get into the fractal section with the market structure. But anyway, let's look for that hangman, and we'll talk about the hangman as we go on. So the market pulled down, and now the market moved down, and then we're looking for a pullback, a correction. So this is the impulse move, then we're looking for a correction. So that's not considered a hangman there. A little bit of rejection at resistance here because the body still looks like it's bigger than the wick, or at least half. They're both the same size. All right, and then you could see we traded inside. So this was probably more like a Friday than we opened up Sunday here. And then this looks like a nice hangman here. All right, I don't like the wick there, and I don't want to be this far down, and I like to get as close to the support and resistance level as possible. Then the market continued a little bit to the downside. So we have a move to the downside, retrace, and then move back down to the downside, it looks like. And this is just looking exactly like hangman right here, both of these. This is a nice hangman right here, but it's not near my level. I wouldn't just trade this out of the blue. I want to trade at a level of support or resistance when I'm trading my trades, as I said before. So we're going to look for a trade at resistance with a hangman, and this is what I'm looking for. We're right at the level. We bounced on the level. This is way down here, and that gave me room for the market to move higher. Now we still do know that the market can move to this previous high way back here, but we're going to use this support and resistance level in our hangman to trade. So when I get a hangman, quite naturally the way I'm going to trade it is just this, like this. Now sometimes these trades are going to be too big for you, and you're not going to be able to take these trades. I'm right at the bottom of the wick right here, and then I'm right at the upper of the base. So this would be where my entry is, this would be where my entry is, and this would be where my stop loss is. So let's mark those levels. Stop loss a little bit above, and entry is going to be down here. Now this is going to make your entry and stop loss quite big. So sometimes, like I said, you may not be able to take a trade based off of that. So the green line is our entry. Let's see what the market's going to do here. So the market comes down, looks like it hits right on that level. That's why I like to be a little bit below the wick, because the market seems to know so much stuff. And it probably triggers us in here if we're triggered. Let's say we're triggered. Now the market retraces. You're in a losing trade if you're right at that level. So there's two ways that we trade this. You have the aggressive entry and your conservative entry. So first of all, this is the aggressive entry. We're putting an entry level soon as it hits that point. Now it may have triggered here, I'm not sure, but you could see what happened now. We did get triggered here. So you definitely got triggered, but we were still inside this candle. You got triggered, so naturally I moved my stop loss to this level here. I want to be at this candle. I don't want the market to come back. Now I probably move it to this point here because this is right next to this candle and it's the highest level. And then you can see the market took off. So now you could move your stop loss down. So the other way to trade is going to take you out of the box. You're way out of the box. You got a hangman here, and you wait for the candle to close, would take you way down here. This trade, you wouldn't even be able to get into that trade. It's such a big stop loss, so much profit already that you would never even really be able to take that trade, even if you had your stop loss here. I mean, because this is going to be the conservative entry, and it took us way out of the box. So that's what I'm saying. Sometimes you're not going to enter a trade just based off of the setup may be perfect and everything may be perfect, except the risk is too big for your account. You know, everybody can't trade 100 pip stop losses or 50 pip stop losses. Some people can't afford that. So it depends on how big that stop loss is going to be. All right. So you can see what happens. The market takes off, moves to the downside. All right. when we look at this hangman here, you would say that you would think that it was a bullish indication because price got pushed all the way back up here. Well, exactly what it's telling me is that it's a bearish indication, because even though price did get pushed back up, the market was moving to the upside, and this is where we saw selling pressure, where the market was able to get pushed this far down. Once it got deeper down into this point, then that showed that there was strength there. But even though the bulls did push it back up, and then eventually they lost the trade. And you can see the hangman, really I could trade these bodies, but I've done so much research on this stuff that looking at this, these candles, a lot of times you'll see candles that like to hang inside of this body of this hangman. So they'll hang, not the body, but the range from the top to the bottom, from the high to the low. And then sometime they'll come back all the way back and then take you out and then continue to downside. So I really don't like to trade these in certain situations. That's why I don't really put my entry here. I mean, you can put an entry here with a stop loss here. It'll give you less risk, and I'm not saying that's not something that you can't do. It's just something that I don't really do, because I really want to see that this is really a true, I see that it's a hangman, but I want to really see that the reversal is true, that we got a true reversal and that it's confirmed. You hear a lot of people talk about confirmation, good or bad. You know, this is some personal things that you're going to have to decide to do, you know, but still, I still wouldn't even trade the hangman much like that myself. All right. So the hangman trade, sometime it may take you out of the trade. If it's such a big hangman like this, you may not get into a trade. All right. So always remember that you want to trade based off of your risk and your money management. And that's the main thing. Once you get a signal, you want to make sure you are still in line with your money management. All right. So that's looking at the hangman. From the hangman, we're going to go right to the bullish engulfing, and that's going to be another pretty good trade setup. All right. So let's move on. All right. So we want to look for the bullish engulfing pattern, and the way we're going to trade that is in an uptrend. We're going to look for a pullback to support. So with the bullish engulfing, we want to trade support and trade that to the upside. All right. So you could see the market here is moving to the upside. Then we found resistance here, but then the market broke through. So it did look like this market was going to fall here, but then the market broke through. So now we would be waiting to see if price could come back to our support level. This was resistance, now support on this side, and this is where we're going to look to take our trade. So we'll let the market run and see what we get here. So we're moving up, and now we hit this level. Okay, so now this is where our interest starts to develop. We're not interested in the market all this time here until we get to our level. We trade pretty much levels. So the market's in an uptrend. We're going to look for a pullback down to this level here. So when we see the market pull back to this level, this is where we're going to be looking for our trade. All right. So now I'm going to start looking for some price action to enter the market. All right. So let's see what we find here and what happens. Let's move this. So you're always going to have levels that you're interested in. Most of the time it's going to be like a support and resistance level, fractal levels, and they're all support and resistance levels. Now you could see what happened here. This candle hit the level at the bottom, then we had another candle, green candle, develop. Basically we had minor support here with this tweezer bottom. So we needed the tweezer bottom to determine support, minor support. But then you could see this is a bullish engulfing candle that just engulfs this whole candle. Basically this is almost an outside candle that we will be talking about a little later. I mean, because it engulfs every part of this candle, not just the body. It engulfs this lower portion here of the low and the high, with this low and this high. But we're concerned right now with the bullish engulfing and looking at this body engulfing this whole candle. All right, so this body engulfed that body, the whole body, from the open to the to this close high here. So with that engulfing candle, this is where we would want to look to get into the trade. Now see, with the engulfing candle, you can't trade it based on like just putting an entry at this level. I mean, you can do that, but you wouldn't be trading the engulfing candle. You would be trading the high of the previous candle. So you would be trading the break of the previous high. And we're going to get into all that, but this right here is a bullish engulfing, and this is what we would be looking to trade. So now we would get into the trade at this point when the candle closes. And so when the candle closes, my stop loss has to be way down here below the candle at least. All right, so that's a pretty big stop loss. Sometimes these are going to take you out of a trade because the distance moves is so far, which is going to give you a higher risk. But with that distance move, that also lets me know one thing, that the possibility of this moving to the upside is even greater. Because we see at this point there were all bears in the market here, and then right here, here's where the buying pressure came in, and you can see how it just took off with a strong bullish market where all the buying pressure came in, strong demand here, the market moved up to the upside. All right, so this is my level where I will be getting into the trade. So let's mark this with a green line. That's our entry. Green is going to be our entry. And then our stop loss will be down here somewhere. So we'll just mark stop loss down here. Make that red. And then that's our stop loss down here. All right, so like as I was saying, we cannot trade the break or violation of any of these levels here, because then it wouldn't be a bullish engulf, and it would be totally different to be trading that. You'd be trading the break of this high, which could be looked at as a bullish engulfing, so you know that's going to, what the candle is going to close as, but it may not close as that, and it may pull back inside here. And with this big candle here and this long wick, I wouldn't want to get caught in a trade where it triggers me in up here, and then I'm sitting in the trade as it moves back down here and goes sideways for a while, and then maybe eventually drops to the downside. So with that, where's my first target that I'm going to look to find profit? Now, I don't, like I said again, I don't take profit necessarily. I can, but it's going to be a level where I'm looking for the market to go to. Now, we're already halfway there, but it's you always look to the left of the market to find the next support and resistance level, and that's where you want to go to with the market. So we'll put a pending order to take profit here. There's a lot of ways we could do. We can wait for the market to get to this point and see what it does. So let's let the market do what it's going to do and see what happens here. Okay, so this candle didn't close yet, but our close, so really our entry would be here. Saved us a little bit. And then now we're looking to get to this point, at least just to get to that point. And the market is moving and looks like it's trying to attack our level. So we always move to the next support and resistance level. And finally, boom, we're hit. So we're triggered in. So now what I'm going to do is this. I know I made this profit here, so I want to see if I can let the market go a little more. So I probably just move up tight to this level here and let it go, see if it goes. I could move here, but I don't want to lose that much profit. So I'm going to give the market a chance to violate this resistance, the resistance level. And if it can, then I'm in a good trade. So there it goes. It violates. And now I'm even better profit because the market violated here. And now I can stay 2 candles behind the market, but I've made my profit already, and I want to make sure that I'm safe here. So I'm playing it safe until the market gives me a good run here, because we see some rejection here. So this rejection is telling me that even here you had some rejection, and even stronger rejection, that maybe there's some selling pressure up in this area. So let's see what the market does, and then the market comes back and triggers us out. No matter where we would have put it, we would have gotten triggered out, and the market moves back up higher. Market has a market knows where we are, doesn't it? And then you can see what it does. Boom. So the market is attempting to come back at this point. Now we could probably move to the upside. We would look for, again, if we're trying to trade this and the market's moving to the upside, we're going to trade this support level, look for a price action entry at this point. So that, my guys, my friends, is going to be the bullish engulfing pattern, and you can see how it worked there. So looks like it worked out pretty good this time. So that's trading the bullish engulfing, and the next one we're going to look at is the bearish engulfing. All right, so let's go right to the chart and look at a bearish engulfing example. All right, traders, we are now looking for the bearish engulfing pattern. It's going to be a trade that we want to take in a downtrend because we want to trade that off of resistance. So here you can see this is maybe resistance because it hasn't been tested yet. The market was in an uptrend. We want to see what's going to happen at this point. All right, so the market hits that resistance level and then drops to the downside. This is a bearish engulfing candle here, not a trade that I would take. The candle body is very big, way bigger than this level here, because in order for this to be a bearish engulfing candle, okay, it has to close outside of this candle body, and when it closed way down here. If I put an entry here, I don't know if it's a bearish engulfing and the market moves higher. Okay, but you will learn a technique to trade these candles and catch them quicker than this. But a bearish and bullish engulfing pretty much going to be hard to catch much quicker if you want to make sure it's a bearish engulfing or a bullish engulfing. But here the market was in an uptrend. I had some signs that this was going to be the end of the market uptrend, basically because it had a double top here. So we bounced off of that double top. We lost momentum and it looked like the market wasn't able to drop to the downside. Now again, I don't really call this a double top because of distance. So you need more distance to cover this, call this a double top. A few candles away is not really a double top. It's just a strong resistance level that the market wasn't able to get through. So what I'm going to do here now is I see this support and resistance level here, right? And I like to make these into little zones. Okay, so I'm going to make this into a zone. And I use the wicks here, and you'll learn more about this when we talk about support and resistance and all that stuff. So this was a bearish engulfing, and you were not able to catch this trade. I think it was too big. I wouldn't have been taking that trade myself. But then the market moved to the downside. Wow, if you did catch it, it would have been a really good trade for you. But the market moves to the downside. Then you can see another bounce off of this level, and then what happens? Another bearish engulfing candle. These bearish engulfings are very strong. Another one that I probably don't get into because look how big it is. Again, it's even bigger than the last one, but it's given me an opportunity. Now it also created a bull trap, and we'll get into those again more, but you could see where it trapped bulls who were expecting the market to go higher above this resistance level. Trading breakouts of support and resistance levels will get you into a trap. This here case is called a bull trap. But then the market continues to the downside. And as the market moves to the downside, we're looking to trade resistance again. You can see we have a little support there. We could put a little support here. A little bit of resistance now. Was support here. If the market comes back to that point, we would look to trade here. I would make this into a zone and look for my trade up this zone here. Now when I have my fractals in, I see this a lot better. But then the market continues to the downside here. So as the market continued to the downside, finally comes back to this level here. All right. So in order now, once this candle closes and we're at resistance, and I know that maybe we'll see a move to the downside, I want to see if it's going to close outside of this candle. Now when we start learning about inside out trading, you're going to catch this trade right off the bat here. But currently we're not going to do that. So we're going to trade based off of what this candle is doing. And when I get a close above this support and resistance level here, so this resistance level, I'm going to take the trade off the table, and I'm not going to be looking for this to close lower than this point here. So again, you could see this was another bull trap. As you could see, this was resistance here, and all those traders that trade breakouts of resistance, support and resistance levels, they're trading to the upside on resistance, when really you should be trading to the downside at resistance. All right, so these traders that got trapped again, you can see the market now moving to the downside, and they're going to all have to sell their positions. And we talked about that when we talked about these earlier. So let's let the market continue. So we don't know that this is a bearish engulfing candle yet, but now we do. It closed outside of this level. So automatically my trade is here. And again, this is quite big, but I entered the market there. So that's going to be green to let you know that's my entry. And then my stop loss, I'm going to put it a little above the support and resistance level, but more than likely I usually move it to the high. Now if this is going to be too big of a stop loss or too big of a trade, it's one that I have to take off the table and look for something else. But that's the way I'm going to trade this right off the bat, okay? And so we're going to see what the market does. And if I'm already triggered, then where's my next target that I'm looking for profit? It's going to be right at the next support and resistance level. Look to your left, find that level, and that's your target. So let's see if we can hit that target, and we'll close out our trade. So the market's moving down. It's hard for some of these traders to let go of that position, and the market keeps moving to the upside a little bit. You have some indecision, you could see, but the market continues to move down, and the bulls are being defeated by the bears, and this market continues. The bulls do not want to let go of this though. So look at this candle by candle, and again you could see this high here, this high here, this high here. We don't want to violate this high, because then the market momentum is changing. This high here, we don't really want to violate these highs. Now we got these little candles, so now we got some indecision in the market. We see that indecision, that means a lot, okay? So we're still shooting for this target here. We haven't violated this high yet, and then we haven't hit our target again, but boom, now we're triggered. We hit our target. That's the end of our trade. We're good to go. So we hit that target that we shot for, and then I see the market starting to pull back. Yeah, I'm taking my profit for sure. So I probably get out somewhere in this area. If I have an order already set at this level, then I'm secure at what the position that I wanted to take and the profit that I wanted to take. So sometime you can set your trades right up. You see what happens. Boom, you have your stop loss, you have your entry, and then you have your target. You go to bed, wake up, you got profit, you're done. That's a nice trading. All right, so that's looking at the bearish engulfing. So we're pretty much done with the engulfing candles. Let's now move on to the morning star candle. All right, so now we're going to talk about the morning star. We're going to look at trading that morning star pattern. Now this is a 3 candle pattern, so we need 3 candles to develop and close before we really know this is what this is, if it's a morning star or whatever. Okay, but the thing is, I want you to look back, because this is where we took our last trade that we talked about prior. We took a bullish engulfing trade. This was the area here. Now you could see this was a support and resistance level, and you could see I have this area drawn as pretty much like a zone, because you had a little bit of indecision here and maybe consolidation, if you want to call. The market was in an uptrend, right? So every time the market pulls back, we're looking for a trade at support. So when we're trading to the upside, again, another rule, you want to look for a trade at support, and that's pretty much a rule of trading this way. You want to trade with the trend, and you want to trade support. You want to buy those pullbacks. All right, so with that said, we're going to see the market continue to the upside. We're going to look for the next pullback level. All right, so let's see what the market's going to do here. So just looking here, and that's a big drop there, and now we hit right on support. We're within this area here. So support and resistance is not just a line, guys, it's an area, so always know that. And a lot of times I'll draw big zones and to show myself where that support and resistance level is. We'll talk more about that when we get into our support and resistance trading. But then we had a hammer developed here, so this looked like a really good hammer too. So it would have been a trade that I probably would have looked at taking, and probably would have more than likely taken this trade. And you could see the market attempted to move higher, then it took me out with indecision, then dropped to the downside. Made another hammer here at support. Now here's what the market loves to do to you. It loves to destroy your courage. It loves to destroy your mentality, and it likes you to get to the point where you're hesitant and scared because you took this candle setup that was everything that you would talk about taking on a hammer, and the trade didn't work out, and then it gives you another hammer, and now you're hesitant to take it because the market destroyed your mentality. So now you don't have any you don't have the courage to take another trade because you just took a loss. So now you're going to sit on the sidelines and let the market go. All right, so then the market comes and shows us a lot of indecision here. And this is when I start seeing this kind of price action, guys, where the market's sitting at a level, there's a lot of indecision. There's rejections to the downside, but there's also a lot of indecision. I kind of stay away from the market. I kind of stay out of the market. A lot of times I'll box the market in and I'll say I'm not going to trade it until it gets beyond a level. So maybe I box that market in and I say to myself, well, I'm not trading it until it gets past this level. Or I'll put a price alert in and it'll let me know when it gets, or I may say that I'm waiting for the market to get past this level, because I don't want to see this kind of stuff, indecision. I want to see the market moving. With all this indecision, yes, I could get taken out of trades a bunch of times. All right, so then the market continues. It drops lower to the bottom of this support and resistance zone. And the market's made a new low here, so now I know that this is a possibility where the market could go to. And we're violating lows, we're violating highs. Remember, I showed you when the market's moving to the downside, we started this downside move. We didn't really come back and violate this high, nor this high. But then we made this last high and then we violated it. And then we violated the low. And then we violated the high, violated the low. So a lot of indecision here. It's like a tug of war here. You know, this is where we probably have something like this. So you got bulls here, you got bears here, and both of them are pulling at this area, and that's why the market's not going anywhere right there. So someone has to make up their mind. So now, right at the bottom of this support and resistance level, what do I get? I get this little candle here, and then I get a little indecision candle, almost like a spinning top, almost basically not really a doji, but a little indecision candle, and it is kind of a doji. So now I'm starting to think of that trading pattern, the morning star. So what I would need now is another candle. So these first two candles give me that star, and then there we go. So with the morning star, you don't want to trade as soon as you see this. This and this does not confirm the morning star, but this does. And this star, this next candle represents a lot here, and I'm going to talk about it. So when we see that morning star develop, we want to see, basically we want to see the market close above this point here. All right. But the market, even if the market didn't close above that point, say this candle closed here. What the thing is, we want to close higher than this little doji here. And when we close a little higher, the stronger the move is to the upside, the higher into this body we'll get. So with this one, we closed above the high, so we knew this was probably a pretty good trade. So right here, we're going to have our entry right here. So here we put our entry, and we'll make it green. And here we'll put our stop loss. I want to put it below that wick there. And I'm going to tell you this stop loss. So to me, this is not the best technical stop loss. It's the one with a little bit least risk. But here's the thing. The market came all the way down here before, so it could test this level again. So I know that it could come this far. Very big stop loss. So the best stop loss that I could have is either here, but I can put a stop loss and be a little bit aggressive with a stop loss below the candle that violates, that closes out the formation. So we entered the market here. Now if this candle would have closed right here, we would have entered the market there. All right. Now what I like to see, I want to get above this level here. So this is going to more so get into our trading style when we start talking about inside trading, when we trade inside out. So the market's inside of this box here and trades outside of it. All right, but basically that's why I said a lot of these patterns that I'm showing you, we don't even have to remember. If we didn't know this was a if we didn't know this was a morning star, then if we're trading inside out, we still would catch the trade, but we didn't know what the formation was. But we're going over the formation, so here's what it is, and the candle closes here. So where's my next level that I'm going to look to take profit? Or at least look to where I might want to take profit. It's going to be to my left where the next support and resistance level is. So that's a good move here. We'll put a pending order in and let's see what happens. So now the market kind of scares me. When I see this, and it looks like the same thing that we saw here, the market should move higher. But before I see that, I see this. When I see this little bit of indecision, I get kind of worried here. All right, so maybe that means the market may drop to the downside. So what I'm going to do, I'm going to move my stop loss. And I'm going to stay 2 candles behind that a little bit. So then the market moves. And then the market moves. So now I'm going to really get 2 candles behind. And I like where we are now. So we're 2 candles behind. Basically, we should probably be more like here, but we're right at the little indecision candle right here. So and then the market comes down, takes us out. So our trade would have been over and we would have made profit here. But you could see that's trading that morning star pattern. All right. And so that's really all you have to do with that. So no matter where this candle closes, so say my green line here is the close of this candle here. If that candle closed here, I would have taken the trade. But the safest trade with more higher probability is to get above this level with a close. But the higher up into this body that the close is, the higher the probability. So if this candle closed here, a little less probability, but here, here, and then finally up here, and then it closed above. This gave us a strong probability, strong indication, strong buying pressure here. You could see there was a lot of indecision here. Then the market dropped with all this indecision, and finally there was a choice made, and then it took off to the upside. So that's trading the morning star pattern. Now we'll go look at the twin brother, well, almost the opposite twin brother, which is going to be the evening star. And of the 2 patterns, I find that the evening star gives me a better profit than the morning star most of the time. All right, so let's go on and look at the evening star pattern. Okay, so I want to take a look at another morning star trade opportunity, show you how to trade this again. But now, first of all, I'm looking at the overall market, and I can see at this area here, we're pretty much sideways, pretty much in a range here. So I'm not going to trade too much of anything. When I look back at price action, I want to see a good moving market. I don't want to see all this kind of stuff here. Now this is a range, so I could trade this as a range, but I really don't like the price action on it when I have a lot of candles that are bouncing off of a level with a little bit of indecision and then not making a clear-cut move. But now here it looks like we had a good move, and then we had a nice move off of here, moved up to this point. So actually the moves aren't that bad. But sometimes you get into a range and the range is very sloppy, so I stay away from those sloppy ranges. So we're really not looking at a range trade here. What I'm looking for is to see which way the market's going to go, because I want to get back into the trend. So if the market, I box this market in because once it breaks out of this level, then I'm going to be looking to trade whichever direction this market decides to go. All right, so we'll see which way it goes, and see with this rejection here, we start to think, just as we saw rejection here, we start to think that maybe we're going to go to the downside. But the thing is, we've hit this level 3 times. Eventually, we have to lose this struggle here. But there is indecision here because, and with the rejection, so there's not a clear-cut decision on which way the market's going to go. But then there is a clear-cut decision here with a monster candle, a strong bull candle to the upside. So I'm going to remove this level, and a lot of times, let me show you what else I do. So we break out of that range. A lot of times I'm going to look for the market to come back to that level and then trade it. All right, But we have a nice support and resistance level here. So we're going to see which level the market wants to honor, because it sometimes comes back to the range level here. So we'll see if it comes back to the range or to the support and resistance level. Okay, so it looks like we got into a nice move to the upside. And now the market's moving higher. We pulled back here a little bit. Let's move this range over, because we're going to use this as support now. And now the market comes down. It violates my range here. So when I see that violation, I'll just look at the support and resistance level here, because that range top was going to be a support and resistance level. Now the only thing about the range top was we're using this wick here, the top of the wick. But here now we're just using the bodies. And when I make a range, I like to use just the bodies myself, but you have to use the wicks. So what I'll do is I'll put another line in there for the bodies to let me know that that's where the price has been closing. All right, but the wicks are where the actual price has been. So now we're right at this support and resistance level. So what are we looking to trade here? So we broke out and we came back on this level. So what I'm looking to trade is to the upside, right? We're going to trade support and go to the upside. So look what this candle is. A little hammer here, it looks like. So a possible hammer here, but then we get a tiny indecision candle. This is ridiculous. All right, so this is a daily candle, and the whole day the price did nothing. But what tells me something is that look how strong this market was to the downside. If it's so strong to the downside and then you hit this support level and then for a whole day you get nothing at all, you get total indecision by the market, that's a sign that something's going to happen here. Something has to happen. It either break out to the downside or to the upside. So we're looking to trade to the upside because we're trading at a support level. We want to trade support to the upside, and the market was moving to the upside, and we'll call this a correction quite possibly. All right, so now I'm almost trading the hammer, okay, but I do see this nice indecision candle. So let's see what the next candle gives us. So the next candle, if I was trading just that hammer, I could just trade that level anyway where I am. Without really even taking note of that indecision candle. But now look what happened. So we closed. Let me remove that. We have that 3 candle formation. We have the bear candle moving to the downside, then we have the indecision, and then the bull. As I said, the market's moving strong to the downside. If it's going to continue, you shouldn't see much indecision here. And then it really shows that the bulls came into the market. This was a lot of buying pressure here, and the market took off to the upside. Quite naturally, my entry is going to be the close of this candle. Make that green. That's my entry. My stop loss has to be minimum below the support and resistance level here. So I'll just use the wick here. And that's going to be my support and resistance level. So now let's see where this market goes. And my target, always looking to my left, I'm going to go to the next support and resistance level. And boom, the market hit that support and resistance level. I'm kind of scared you here. You probably would have taken your profit here. You probably would have been out of the market. Wouldn't have made too much profit after this move because you had such a strong move to the downside. We probably had another chance to really get in, but we didn't really bounce off of that level. But this trade, if you could manage this, because this would really be scary, you really don't know if the market's going to continue. If this is just a move to the upside, then a pullback, and then a move to the downside, because we had a bearish engulfing here. All right, so you probably wouldn't have really known what to do. But if you kept your stop loss where it was and then you fell asleep and then you had your target already set, boom, you're going to get that target, but you'd have to be sleeping for 3 whole days. All right, so I don't think many of us will be sleeping for 3 whole days. But anyway, that would have been a good trade to the upside, and you always look for your levels for you want to take profit, or your target levels based off of support and resistance to your left. So this was a nice, a very nice morning star trade, and that's what you would be looking for, guys. All right, so we're pretty much done with that morning star. I'm going to move on to the evening star and let you see what that looks like. Okay, so let's look at this evening star pattern and a trend. Basically, this is not a really strong trend, but we're still trending to the downside. So I'm going to show you, I got some support and resistance levels drawn in here. So here you see this line here, that's going to be support and resistance level. I'm going to make it red so that I always like to make support and resistance red. So you can see that's a little bit of a support and resistance level. The market's trying to move to the downside, but it's more sideways. Then we got a little move to the upside, and then we pull back a little bit more, and then we remain below this resistance level until finally the market violates. But we're still below this level, so we're trying to move to the downside. So it's not a super strong trend, but we're looking to trade to the downside. But now price violated this resistance level. So now we're going to play this out and see what the market's going to do for us. So now the market faked going above this level. It really went above, but then now it's pulling back down. All right, so now with the market pulling back down, we are looking to trade to the downside off of this resistance level. So we have a moving market to the downside, a little trend started to the downside. So now you get your pullback, and your pullback is right to the support and resistance level right now. And then with that, you get this candle here. So now we do have the 2 candle formation started, because we have our first candle, which is bullish, and then we have an indecision candle. This is a nice big doji here, but it's basically an indecision candle because the market opened and closed pretty much at the same level. If this trend is going to stay in context, or this correction to the upside is going to stay in context and continue moving, it shouldn't find hesitation here. It shouldn't find indecision here. It shouldn't find exhaustion here. It should be strong enough to continue moving to the upside. So with that exhaustion and with that hesitation and indecision, I want to trade what the market shows me. So if the market shows me that it can't go above this level, then I want to trade below that level. So the way that I would look at that is, if I'm trading to the downside, following the trend, so our trend is to the downside, market moves higher. If the market closes above this level now on the next candle, then I would not trade this pattern. But if the market does not close above this level, and as long as it doesn't close above this level, now I just want to see the market close outside of that level. All right, and so the way that I know it's a strong reversal is because the farther it goes into this bullish candle here. So I just boxed this little area in because our trade now, we want to see the market close outside of that level. Once it closes outside of that level, we're into the trade. All right, now we don't take the trade here. Now some traders may take the trade here, because really when I look at taking a trade like this, I'll take indecision and trade that. But because also that indecision is showing me rejection too. All right, because the market was pushed higher, but then pushed right back down, and then nobody took control. So really there's indecision mostly, but also rejecting that upper level. So now I want to see the market drop to the downside. Also with this pattern, we could see more than one of these dojis here. We could see 2 or 3 and then get a candle to the downside. All right, so let's play this out. So we see what the market's doing out. Then the market drops drastically. Already now I'm looking at this and knowing. So my main thing here now is wait for this candle to close. We want to make sure we close below that level. But once we close below this level here, we're good to go, because that signifies that we have now decided there's no longer indecision. The bears have taken control and dropped this market to the downside. So where there was strength to the upside, we found indecision, and then we found strength back to the downside. So let's see where this thing goes. And see, now our entry is down here, and my stop loss has to be at least above this candle. So this is the way we would take this trade. Down here, my entry would be here, and my stop loss would be minimum at this candle here. All right, big stop loss. If these stop losses are big, when you have some of these 3 candle formations and you can't get into the trade, well, it's just a trade that you miss out on. And then also you could even put your stop loss above that level. But now the other thing is, this indecision candle, this doji, we trade this doji pretty much like we're trading the hammer, the hangman, and everything of that nature. Where we see rejection, we want to trade that rejection to the downside or to the upside, whatever. So we're not really discussing this, but when I see this, a lot of times I'm not looking for the 3rd candle. I'm not looking for the 3rd candle to be, you know, to tell me that this is an evening star. A lot of times I'm putting my entry right here, and I'm going to limit a lot of risk, because if I have indecision and then the market decides to go to the downside, I'm good to go. If it decides to go to the upside, my risk is a lot less just playing this indecision candle with a stop loss above that level. But playing this evening star, this is where we would enter, and then when you look to your left to find your targets, as usual, you look for support and resistance levels. Now I'll go past this level because that is right next to where we are, and then the market takes off and moves to the downside, and you got yourself a good trade. Now when I see a lot of candles like this and I'm following two bars back, maybe I might move my stop loss down to this point and then let the market trigger me, and it didn't. So I stay 2 bars back, I stay here, then I'm 2 bars back. I'm really going to be here now. Also, I have a fractal. When we start learning about fractals, I'll tell you, I use fractals as stop losses a lot, quite a bit. You can follow those. And then the market moves to the downside. You're pretty much good to go. Moving that stop loss. This is just how you want to manage your trades pretty much. And you can see this basically here. This area here is pretty much consolidation. And we're going to learn to trade that kind of stuff, consolidation. It's going to be inside out trading with that. So with that, I know that I want to have my stop loss a little bit above that level. Because now if the market's going to continue to the downside, it'll go down to the downside, close below this. If not, it's going to come back up and trigger my stop loss. And it closed to the downside, so we're good to go. And now I'm going to move my stop loss down at least to this point where we broke through, and then finally we're taken out right there. So that was a good trade. So that's looking at this, pretty much looking at the evening star in the context of a trend to the downside, because that's what you're going to trade it off. You're going to trade it off resistance, and you're going to be trading to the downside. Now we're going to look at it in a ranging situation. So let's look at a ranging market. Okay, so let's look at the evening star in a context of where it would be in a ranging market. Pretty much sideways, we're in a range and the market's bouncing on support and resistance levels. So you see I have this level up here. This is going to be the resistance level. I'm going to put a level down here for support, because this is going to be the next support level. And then we're going to watch this market, and we're going to look for this evening star, and we're going to look how to trade this evening star. So the market's sideways, as you can see, and it's in a range. Didn't quite hit that support and resistance level down here. So just remember, support and resistance is not really a line, guys. It's a zone, it's an area. So now what happened here was Friday. This looks like it was a Friday, because in Forex we don't really gap up or gap down unless it's the weekend and then the market opens on Sunday. You may get a gap. So this was a good sign here. we got a gap up. So with that gap up, you're probably thinking that we're going to go to the upside and we're going to violate the resistance level. And then you could see the little indecision candle here though, like almost like a spinning top pretty much. So with that indecision, we'll call it a little indecision candle after an uptrend. So what this tells me is one thing. You could see the market had a nice move to the downside. Then you could see how strong it was to the upside. If this is a strong market to the upside, after two strong candles, we shouldn't see indecision at this level. We should see more strength at this level, but instead we see indecision at this level. So let's see how the next candle plays out, because now we're looking for that evening star pattern based off of these two candles that we see. So this evening star pattern is it's a 3-candle formation. Okay, so now I am really starting to think that this is an evening star pattern. Okay, so with this pattern right now, the farther down that this moves into this body of this next of the first candle, the candle that starts the formation, this bullish candle, the farther this bearish candle moves down into this body, the more credence this holds for a trend reversal at resistance. Okay, so you can see we're almost halfway through that body. So that's going to show us some strong downside momentum there. And then you can see it continues and it goes even deeper. All right, so the way we would trade this now, it's going to make us have a very big stop loss here. All right, so you see where the market closed. The market closed right here. This is not an evening star pattern until we get a close on the third candle. The third candle has to close bigger or farther down than this indecision candle. So it did that, and then the market, it closed almost even like 3/4 of the way through this candle here. So that was strong momentum to the downside. So I probably don't take the trade because it's so far away, and I want to be as close to this level as possible, as close as to support and resistance as possible when I enter a trade. This is a range, so we're pretty much near the middle of the range by the time we enter the trade. So it's really a big stop loss. So a lot of times you have a trade and it would be a perfect setup, but it's not a perfect trade because maybe the stop loss is too big for you. So every perfect trade is not a perfect trade. For some people it is, and for others it may not be. So if this stop loss wouldn't be too big for you, then you can take the trade. Now there's a couple ways that I would play this. So I would definitely enter here with this candle, with this close of this candle. So that's going to be our green line. Okay, and then this, my stop loss has to be minimum at this candle here. Okay, but ideally I would want it up here. So you can see how big the risk is. The risk is very big, but ideally that's where you're going to want to have it. Okay, and so our first target's going to be, actually I'm going to play this to the bottom of the zone. I mean, I could look for this level for my first target, where I'm going to look for maybe, okay, so this is going to be our level where we start to look for the market to maybe pause and go to the upside. And if it violates this level, then our next level will take profit at the bottom of the range. All right, so we see the market approaching that level. Looks like it bounced off. Now here you may get nervous and take profit because you could see a good bounce off of this level that's pretty much support and resistance. So you probably would look to take your profit. And then the market comes right back down and hits your level right here for a good trade to the downside. And that's where you would have got your profit. You would have profited this whole trade here. All right, so that's looking at the evening star in a range situation. All right, so you can use it at resistance where you're going to trade a sideways market, or you can use it at resistance where you're trading a market to the downside. So on the downside market, the market pulls back on the correction to a support and resistance level, and you'll see more of those levels that we look at. Once it hits one of those levels and you're starting to look for that formation, then you see that formation and you get into your trade to the downside. Continue with the trend to the downside. All right, so that's looking at the evening star. Let's move on to the piercing pattern next. All right, traders, so now we want to look at the piercing line pattern, And again, this is going to be a pattern that we take during a bullish market. What's going to happen is really we want to take it on a retracement, so it's going to be on a correction, so it will be a bullish reversal pattern, okay, because we're going to reverse from bearish to bullish. All right, so looking at this pattern, I just wanted to show you, I'm looking at my support and resistance levels here. You can see this was support here, and then all through here it was resistance. So we're going to follow the market, see what the market does again, and we broke through this level. Then we came right back through this level. Looked strong. So it appeared that usually when you break support and resistance with a candle and it's a strong big candle, that's an indication that the move is going to continue to the downside or to the upside, whichever way you broke. Okay, but here we didn't really continue much, and let's see what we do here. Here there was a lot of indecision, and then finally it looked like the market tried to make a decision, and then we kind of broke higher. So now it looks like our trend is starting to move to the upside, because when we start learning about fractals, we'll see that now this market is breaking this bull fractal here. Once you start breaking bull fractals, then you're usually in a bull trend. All right, unless you're ranging, and we're not ranging, so we're in a bull trend. So a lot of times I find my support and resistance levels by the previous fractal. So if we violate this previous fractal, then I'll look to this support and resistance level here. So I always have a level or a zone, an area where I'm looking to take trades. So I don't just take a trade anywhere. I'm going to look for a reversal here, and I'm going to look for a reversal here. And then finally I would probably look for a reversal somewhere in this level if the market's going to pull back and then give me a chance to get into the trade. So it looked like we may bounce on this level, so I'm prepared to see what happens. And now I'm starting to get very interested because we're sitting at this level, and then the market drops right through that level. So I'm not going to pay attention to that level anymore. I'll delete that. Now I'm going to pay attention to this support and resistance level, and this was a fractal level. A lot of times the market pulls right back to these fractals, and a strong trend, you probably want to come back this far, but you see we're moving to the upside. Okay, so we have a fractal here, bear fractals here. We haven't violated these bear fractals, and that's the main thing. So now let's see what the market does at this level. So now it developed that piercing pattern that we said, because that candle closed greater than the halfway mark of this candle. This red candle here, the halfway mark is probably around there, roughly. Alright, so we're going to mark our entry. That's not going to be our entry yet, but I'm just marking where that midpoint of the previous bear candle is. Okay, so you have the market moving higher, then you get a correction, and then you get this piercing pattern here. Okay, and the first thing you're going to start to notice is we bounced on the support level, and then we started to develop a tweezer bottom, and then that tweezer turned into this piercing pattern once it closed. So with the close, I already know what I want to do. I know that I want to trade this market right here. So I would take my entry there, and I would take my stop loss here. This would be my stop. And then my first target that I'm going to look for profit would be, I want to get past this level, so I definitely want to look at that level. Now I'm not going to, as I said, I don't take profit right away. I like to see either I'll split profit or I'll just let the market go, depending on how it gets to that level. Okay, so let's see what happens here. We got our stop loss and we got our entry here, and look kind of crazy. Now I don't pay attention to this pattern a lot of times, because I usually do a thing that we call inside out trading, and I'm jumping ahead a little bit, guys. You'll learn this a little bit later, but inside out trading would be basically we're trading inside this candle, and when we break outside of that candle, if the market's in a bull run or a bear run, depending on which way we're moving, so we will call this a bull run. If the market's continuing to move higher, I'm going to look for a trade to the upside. If the market was moving lower, I would look for a trade to the downside. So once the market violates this level, but we'll get deeper into that. So right now, this is our trade right here. All right. So then the market kind of came back a little bit. Let's see what it's doing so I can see it. And it hasn't hit our stop loss, but it's having a hard time getting up above this level. So even though, and you can see this is just what I'm talking about, you trade inside of one candle, and that's why I don't really pay a lot of credence to this pattern here, because I know a lot of times you could get many candles trading inside of this one big candle, and that's what this is doing now. And again, if you would have taken a entry here, you would have been sitting in a trade, still sitting. So let's see what the market does, and you're still inside of this candle, and then finally the market takes off. So you never got stopped out. You were sitting in a trade that wasn't doing much for a little while, and then the market takes off. And does it ever hit our level? Yep, it shoots right through our level. So now I'm going to move my stop loss up. And being that I busted through this support and resistance level with a strong candle, I want to be tight. And the market moves higher. And I'm still 2 candles behind. And then I would have got stopped out here. I wouldn't have got much profit on this trade. But you could see if I would have set my level for here, but I waited to try to see if I can give the market a chance to run. So sometimes you have to give the market a chance to give you more profit. But I would have got profit here if I would have just put in my target for that first level here. Would have been a nice entry. I mean a nice target. And you can see we got stopped out with a little bit of profit. And you can see how that trade works. So we got half of our profit basically. But you could see how that trade works here. So I'm not going to show you another one of these, because when we get to trading our inside out pattern, I'm going to talk about this piercing pattern and why I don't really pay attention to it. And you'll probably want to pay more attention to the inside out trade. So that was the piercing pattern. Again, you look for that in a correction of an uptrend when the market's moving higher, pull back to support on a correction, and then moves higher. All right. So that's piercing pattern. Let's go to see the brother, the twin brother, who is going to be called the dark cloud. So we'll go on to check out a dark cloud. The dark cloud cover. All right, I want to take a look at the dark cloud cover now. This is going to be a bearish reversal signal. What I look for a lot of times, I'm looking to trade with the trend. So, you know, you call this a bearish reversal signal, you have to be in a downtrend, you know, in a bearish market to trade this signal. But to catch this signal, you would have to be in a pullback. So basically you want to see the pullback, and then you want to see the market, like after the correction, at the top of that correction, that's where you want to look for this signal. Now there's going to be areas where you'll be able to locate and understand where a correction may end or occur, and then that's going to also help you to be able to look for this pattern. But with all these patterns, you have to train your eyes to see these patterns. You have to work on looking at these patterns. You have to study some chart time, and just whatever time frame you're trading, make sure you're looking. Like I'm trading a 4-hour time frame. Every 4 hours I can just look at my candles and make sure I don't see one of these patterns that I really like to trade, and if I do, then you know, I make my jump. But here we could see the market was kind of in a range because we have fractals that are in clusters and breaking each other. Once we learn more about fractals, we talk about fractals, you understand more about that, because that's going to be all about market structure. So let's see what this market's about to do, and then look for that dark cloud cover. So here we have a support and resistance level. You could see this, that was pretty much the bottom of the range. You could see the top of the range here, kind of sliding off to the downside, but this will be the top of the horizontal range. The market violates that range and violates the level down here. So we violated the support level, which is now resistance. That's what we want to look for. Now we want to look for the market to bounce off of resistance and trade it to the downside now, right? So the market continues moving to the downside, but then we hit this level right here. All right, so now we want to look to see if we can find one of our signals. So every time we get at one of our support and resistance levels, or you know, one of our pullback points based off of fractals or whatever we're trading, there's where we start looking for pullbacks or are looking for price action entries. So this is where we want to start looking for that price action entry. So we're going to let the market move a little bit. Look at the next candle here. And you can see a lot of indecision here. So indecision at support and resistance is a good thing, because when there's indecision on a move up or down, that's almost putting an end to that move, because basically what you're seeing is why would that move not continue strongly if there was no indecision or anything to hinder it. But it's being hindered by that resistance level, and a lot of different traders with a different perspective of what they want to do at that point. So we're waiting to see what this candle does, where it closes, how it closes. It's up and down, back and forth. Okay, but now you can see this candle closed. All right, so what this candle did, we formed that tweezer top. That's gave us a little support level, a little bit of resistance up here. So once we got that resistance, the market dropped, and it closed at least 50% of this candle here. So it closed halfway down the body of this candle. So halfway or more is what you want to see, at least halfway, but more the better, because the more it closes down this body of this previous candle, that tells you that there's even a higher probability for this trade to go to the downside, because you have that much selling pressure at this point. So immediately what this dark cloud cover offers you is low risk, high probability. So what happens is your risk is usually minimal as opposed to what your profits could be. So let's look at how we would trade this. So my box is going to be where I enter the market, and then the top here is going to be the support and resistance level. You put it at the top of the wick of the candle that's piercing the body. So that would be my entry there. And then we'll let the market move. And my risk reward is going to be really great with these kind of trades, because you could see my risk wasn't that big, and I've already matched my risk. And then the market continues to go to the downside, and you can see how this trade worked out. This trade really worked out really nice. So I would be kind of cautious. I would move from this level. I would put a stop loss at least to this point. I would bring it at least, and I kind of should be a little bit above that wick there, because the market kind of knows where we are and seems to attack those levels. But we made profit from this point down to here, and now we're trying to see if we can let the market continue to run. Now, you know, you're not going to always catch every part of your trade or of the trend or of the move that you're trying to make. So I didn't catch this right here right now, because I'm up here with my stop loss, and I want to give the market a chance to continue lower. So let's see what the market does. If it goes lower, it comes back and takes me out. Okay, so I still made profit on this, and it was more than the risk that I put up. So you can see how these patterns work out for you. So that's the dark cloud cover. Guys, you got to get your eyes and mentality trained to start looking for these things. So you should know where and when to look for them. I've been telling you where to look, when to look for them, and which direction to look for them in. So now you need to train yourself to look for these things. They have to be on your mind to be able to see them. If it's not on your mind, you'll see it later. You'll see it after the fact. But if it's on your mind while the trade is going on, while the market is moving, while the candles are developing, then you'll start to look for it, and you'll start to know what you're looking for. All right, so that's going to be the dark cloud cover. From there, we're going to go to the 3 inside up and the 3 inside down, and then we're going to get into some other serious things. So that's it for dark cloud cover. Next up, 3 inside up. Okay, so we're going to look at one of my favorite patterns, the 3 inside up, and I'm going to tell you and show you why in a few minutes here. But just remember, all patterns fail, but it's just getting to see these patterns that sometimes they'll put you in a high probability trade, and when they work out well. But again, all things fail. There's nothing 100% foolproof with the market, because the market's going to do what it wants to do. But this pattern here is it's a bullish reversal pattern, so you find it in a downtrend or a correction. So when the market's in an uptrend, I look for the correction and then find this pattern. So looking at this market, we could see it's in an uptrend. So it's going up here. You can see it's moving higher. All right, and then you have your fractals that you're breaking. So that's a sign of the market moving to the upside. So we're going to look for this pattern, and then we're going to talk about trading this pattern. So the market continues to move higher. And continues to kind of go sideways a little bit, but we're still moving higher. So you want to start looking for this pattern now, because first what happens is you see the market's moving higher. We had a little pullback, then a move higher, then a pullback. This isn't a great trend here, but the market's moving higher, pulls back, moves a little higher, pulls back. Here's where I'm getting interested. Now, we always want to find a support and resistance level or something to trade off of. So we're looking at this level, and we see that we have another candle. Your first candle is bearish. All right, so the very first candle is bearish, but then we get a bullish candle. That's an indication of what may come. Okay, so with this, we want to see the next candle close outside of this candle. So you have a bearish candle, then you have two bullish candles, one closing outside of the other. And this first bullish candle, you want to see it close 50% or higher of this previous candle. That's what signifies more strength. But to me, really, once I see a candle inside of this candle and then the second candle close outside, it really doesn't matter. I don't really look for a candle to close 50% or higher, but it does give you a higher probability, and it shows you that there's more buying pressure or more momentum into the market at that point. All right, so now what we're going to look for, we already see the market, so get used to boxing the market in, because this is going to become a very important part of your trading. Okay, because you want to box this market in, and then the market has to go one way or the other. So now I don't see that pattern yet, because I need the next candle to close outside of this candle here, after we already had a green bullish candle. So let's see what goes on. Next candle. Okay, so this candle closed. Right at the close of this candle, we would have been in the market. And this probably looks like it's going to be on a Friday with the market closing like this and then a gap here. But we would have been into the trade right here, and then the market gapped up. All right, so this is more likely a Friday, but this is still showing you how to trade this. So this would be where we entered the market right here. The thing is, there's two kind of stop losses you can use here. If this market is going to go, you don't want it to come back and go lower than your previous candle low. So you could put your stop loss at this point to limit risk, or you can be a little more conservative with the stop loss here. This is the aggressive stop loss here. It gives you less risk. All right, but to me, if the market's going to come back and go lower than this candle here, then you don't really have the momentum for the move, and then you don't want to give it really that opportunity to come this far back on you. So this is the conservative, this is the aggressive stop loss. All right, so then you can see the market gapped up, and you can see it didn't come back to that point. Now it did, made profit, but now it came back to that point. And now the market's moving again. Okay, so now the market's moving again. Let's take this off. Let's mark this. We have a market that just moved higher. We'll go from this point, and then we retraced, right? And then we moved higher again. So now we want to look for a retrace to get back into the trade to the upside. So now I see this again. Here's our retrace. So again, this is a bullish reversal pattern, right? So the market was bearish. You had a couple bearish candles, a bearish move to the downside, and then you had your support and resistance level. So you're going to learn about these support and resistance levels. This market dropped right off of my fractal level, which lines up right here. We're going to learn more about those fractal levels, and it bounced right there. So let's see what this market does. So now I'm interested because I see this pattern. So let me mark this. So now I'm paying attention to see if I see this pattern. All right, so now we'll let the market play out and see what happens here. So again, we're trading with the trend. We had a pullback move, and now we're looking for a candle close outside of this box here. That will be a 3 inside up. So when that candle closes, we're going to take the trade. That candle closed, and we're going to take the trade. We're going to put our entry here. So that would be our entry, the green line. We'll make it green as we have been doing. And then we'll make this our stop loss. We'll just use this. So this is the aggressive stop loss, but I feel like if the market's going to come back that far, it's not really moving for you, and no need to be back this far. So we are here with our stop loss, and then we're going to see what this market does. Let this market go. Okay, so let's get her moving. Okay, so when we start seeing this here, I kind of get worried about that. You can see we dropped down below here, and now we did gap up here. So I'm kind of worried about this area because you could see this was indecision, but then we gapped up through that level. So we always want to stay tight. We don't want to let the market come back down below these levels here. But you could see this market made a nice move, and you had nice profit here. So I stay a couple candles behind and make sure I have my stop loss set. So that would be my stop loss, and we would have been into a good trade. All right, so that's looking at the 3 inside up. You're gonna have to really understand that when we look at inside out trading, this 3 inside up probably won't even be of any benefit to you, because once we start learning inside trading, inside out trading, you're gonna look for the same thing, but there's gonna be 2 different ways of trading it. So it's basically inside out trading is gonna be either you trade this level or you trade the close of the candle. So it's going to be some form of a 3 inside up, but it's just that you can have candles trading within candles. All right, so we'll get to that, but for now, that's the 3 inside up. Let's go to the opposite of the 3 inside up, which would be the 3 inside down. All right. All right, traders, we are going to look at the 3 inside down formation. I'm not going to spend a lot of time on this formation. Pretty much same thing, 3 inside up or down, because basically when we start trading inside out, you're not going to really be looking for the 3 inside up or down, because it's going to be automatic when we're doing that. So we'll be in more detail, and you won't even have to really look for this pattern. But it's good to know these patterns and good to know these things. So this time I'm going to show you in a little different context, because basically when we're looking at 3 inside, the 3 inside down, the way that I look for it is for the market to be trending to the downside. And when the market's trending to the downside, when we get a correction, at that correction point where the market starts to correct and then come back to the downside again when the correction is over, that's where I would look for my 3 inside down, all right, to trade along with the trend to the downside. But here we're going to trade off of a resistance from the top and trade that down. All right, so let's watch this market as we move higher. And then we're going to hit a resistance level here. All right, so now we hit this resistance level, and now we start looking for, this is where you start getting interested in your trade. When you start seeing getting near this level, now you're starting to look for the price action entry, short or whatever way you're going to be going. All right, but once you see price get to these support and resistance levels, that's when you get interested. And there's all different kinds of support and resistance levels. So now we have this first candle right on the resistance level, and then our next candle. This is almost a bearish engulfing candle, but the thing is we need to close outside of this low. So we're still inside of this candle. We want to close outside of that low. So we don't have the full pattern yet. So we need to wait for the full pattern, and we'll see what happens. And you can see what the market is doing. And then the full pattern closes down here. So the way that I would trade this now, this is going to be my entry right there. Right, so we're going to enter there, and this is our stop loss up here. All right, I probably would be a little bit higher based off of support and resistance level. I know the market may come back and bounce off of that level again, so I want to give it a little bit of a buffer. But you can see this when we start trading inside out again, you really won't be looking for this. I'm going to give you something much easier and much better to look for. But here's our trade, and let's see what happens. So we'll mark this with a green line to make sure we all know where the entry is. So this is going to be our entry, and then we're going to watch what the market does. And you would have been in a very good trade. And you could see pretty good trade. And now it's starting to come back up, but you would have had a pretty good trade. And if you mark your profits like I show you and start looking for that support and resistance to the left. So if we back up here, I'm going to show you exactly where I would have started looking, because you always want to look to your left to see where your next target is, and I've been stating this. So my next target would have been down at this level. So that's where I would have looked to take profit, but I don't always look to take profit. I look to see what the market is going to do when it gets there. Now this was a giant big candle, so I would have held off. I wouldn't have taken any profit, but then this next candle would have really scared me. I would have probably, when it closed as it is, almost like a inverted hammer, I would have tried to take profit right here. All right, but if you let it go, then you're going to lose most of your profit. You can see it tried to run to the downside. Now if you held on to it till it got to this point, if you even held through this, then most definitely you want to have your stop loss down here somewhere. All right, because you have this support and resistance level right here. The market's below that level, so it's now resistance. So you could bring that stop loss there, and just now you would have got hit right there. See, but basically, that's how you manage your trades. You look to the left to find that support and resistance level, and that's where you look for the market to drop down to. If it violates that level, I will go to the next level, look for support and resistance, and look for the market to come down to the next level somewhere in here. I would have looked for the market to come down there, and so forth. So you have to look to your left to see where the support and resistance levels are, and you just trade based off of that. So that's the 3 inside down. And we're going to move off of the 3 inside down and go to the outside candle, which is going to be bullish and bearish outside candles. They're pretty interesting. So we'll move on and talk about those. All right, traders. So now we want to look at the outside candle. We're going to have a bullish and a bearish outside candle. So the bullish outside candle will be formed at support. All right, and then the bearish outside candle will usually be formed at resistance. So let's look at this. You can see we have our support and resistance levels drawn in. So this is not my support level. This is not a support and resistance level. So this is our support level. Here's some resistance here. So you can see we hit right on this support level. So once the market hit the support level, our next candle, boom, It was an outside candle, a bullish outside candle. What's happening here is this current candle's low and high engulfs this previous candle's low and high. It's higher than both the low and the high of the previous candle. Now this is basically a bullish engulfing candle, but with a bullish engulfing, it doesn't have to have the low that's lower than the previous candle low. All right, so the bullish engulfing could have opened right here and just continued to the upside. Now this is probably on this is probably a Sunday open, because Forex you don't really see gaps up like this. All right, so this is probably a Friday close, Sunday open. But if they opened and closed, if this closed here and then this next candle opened right here and there was no wick, the market never dropped to the downside and just went straight up like this would be just basically a bullish engulfing. It couldn't be an outside candle, because you have to have the low and the high outside of the previous candle's low and high. All right, but this also is called a bear trap, and I'm going to show you why. You could pretty much see why, but I'm going to show you exactly why, and I'm going to show you how we trade this. I'm going to show you right now how we trade this. Now, just knowing that it's a bullish outside candle, you wait for this candle to close and you put your entry order here. This is a big risk. Look how much this is already. So I don't usually trade these because I don't like the big distance I get on this. Now if it was a smaller candle and it happened to take this trade, this is really big, so I wouldn't trade that. That's where my entry would be, right at the close of that candle. All right, my stop loss, in reality you have to be below the support and resistance level at least. All right, so that trade I wouldn't even take. Now, just because you see a trade setup doesn't mean it's one that you want to take all the time. I try to tell people that all the time. If it doesn't align with your risk management and your money management, you can't take the trade. So you could pass on a bunch of trades because they don't fall in line with your risk and money management. Now, they may be perfect trades as far as the setup, price action wise, but your risk is much too big. All right, but with this here, we're going to show you just why this is called a bear trap. So the market's coming down. All bears in the market right now. The bears are controlling this, and there's more people that want to jump on the train here to the downside, because this is a support level here, and you have breakout traders that like to trade breakouts of support and resistance. So breakout traders are going to trade this support level to the downside. So you're going to have a bunch more bears jumping on the market here, and these sellers that want to get into the trade. So let's mark these levels here. So let's say in this area you have a ton of mark this yellow. Okay, so this is going to be where we have more orders coming into the market. This is where the market's getting consumed, and we're going to say we're going to split this. All right, so maybe here we'll mark this light green. All right, so let's mark how many orders we have coming into the market. So we're just using some numbers, but let's say here we have 500,000 sell orders, and then here we have 1 million buy orders. All right, and scattered throughout these sell orders here would be some buy orders, and scattered throughout here would be more sell orders. All right, but let's see what the market does now. So we're going to follow it tick by tick. So currently our bulls are looking good, but then the market drops here. It starts to absorb some of these sell orders, so the market pushes down a little further, and now you hit this level where you're starting to get these 1 million buy orders. That's more than what you have on the sell orders. Plus the people that were on the boat are selling already because they're taking profit. They're buying already, sorry, not selling. These people that are already on the boat that sold to get in here are now buying also. So you have even more buy orders coming into the market. So you could see what happens. All these buyers, look at more buyers coming into the market, and they're going to push this thing right up, because now you have more buyers coming into the market than there are sellers, and absorb that. So what happened now, these people that are on the getting into the trade here, they see the market drop down to this point, they're pretty happy. They think this market's going to the downside. All these bears are on the market here, are on the trade here. And they're hanging in there. And now they're starting to get worried. All right, some are going to jump off the boat here. Some jump off here, adding more buying pressure, forcing the market higher. Now a bunch more even jump off here. And now that puts even more buy orders into the market. All right, so the market shoots down and comes right back up. And the way that we trade this, guys, you already can see that you're inside of this candle now, but I wouldn't trade this level when we break this level. What you want to do is trade when this candle closes. So now you would be in the market right here. Now the thing about this, I want to say again, every trade is not a good trade, because some trades are going to take you, your stop loss is going to be much higher than you want it to be. And if it doesn't align with your risk management and your money management, then you can't take a trade. I mean, you can have tons of good setups, but if they don't align with your risk management and money management, then you can't take a trade. A lot of times I won't take these trades because you have such a big candle like this. Now sometime you won't have it, it won't be that big, so you have an opportunity to jump on something like that. All right, so this is a classic bear trap bullish outside candle, and you can see what happens. So if we took that trade, let's say we entered the market here, we have to have a stop loss at least below the wick here, or the minimum we could be below this support and resistance level. So that's quite big. So let's see what the market does. We'll mark this green to let us know that was our order, our entry order. But again, this is probably one that I wouldn't take. You're not going to take every single trade that you see happening in the market, good or bad. So then the market moves, and then here I get worried because I see indecision up here, so I definitely want to move my stop loss even tighter with that indecision. And then the market shoots down. All right, so it would have been a profitable trade, but look how far you had to wait to get into that trade. So sometime you're not going to trade these, and they're very big a lot of times. So that's looking at your classic bull trap, your classic bear trap, and your classic bullish outside candle. All right, so now we're going to look at the bearish outside candle. Same thing, but you just find it at resistance. Okay, I just wanted to take a look at a bullish outside candle during a trend, so you could see. I usually don't trade these during the trend, and again, I'm showing you why, because they're so big most of the time that, you know, your stop loss is going to be pretty big. So you could see we're in a trend. We'll mark the, you could see we're going to the upside, so we're in a trend here. And what we have is the market pulled back, then moved a little higher, then pulled back, then it moved a little higher, then it pulled back here. And then you could see right here, this next candle, you have the red candle here, and then you have this big giant green candle. The low is lower than this low, the high is much higher than this candle's high. This is a bullish, this is a big giant bullish outside candle, and I wouldn't have gotten in on this trade here because my stop loss has to be at least somewhere down here, and I wouldn't have gotten in on that trade. But you could see the market moved higher. All right, so that's looking at the bullish outside candle in the trend. All right, but most of the time you're going to look for these at support. Now, I wouldn't really have said this was support, and you could call a pullback a support level, because a lot of times a pullback will pull back to a correction will correct at a support and resistance level. So if you found this to be a support level, it would be a great opportunity to take a trade like that. But in the trend, a lot of times you'll see you can see the market pull back to a level. A lot of times we look for a pullback level, so a fractal, a previous fractal will be a pullback level. So if you see the market bounce like that and then give you a outside candle like this, it's an opportunity to get into a trade. But again, like I said, a lot of times they're very huge and you won't take those trades. So that's looking at the bullish outside candle in the context pretty much of a trend. So we're going to look at the bearish outside candle, and we'll do that from here. All right, thanks guys. Let's move on. All right, so let's look at the bearish outside candle. Now these candles are going to be more relevant when you find them at support and resistance levels, the bullish and bearish outside candle. You will see these in trends, but I don't follow it or look for it in a trend, and I don't really trade it in the trend. I trade it more at the support and resistance levels because it's going to have major implications when you see this at a support and resistance level, like a double top or a double bottom, something of that nature. Because you saw what I showed you with the bullish inside out. You saw how there's breakout traders waiting to trade those levels, and once they add to the input of the trade, it's just a bigger trade. It's much more relevant at support and resistance levels. All right, so let's look at this bearish outside candle at resistance. The market's moving higher. Then the market hits our resistance level, and then boom, right on the level. All right, so now this is whenever we get into these areas, this is when I start getting excited about a setup, start looking for a setup. I even put price alerts in here to let me know when price is at one of my levels. But anyway, let's see what the next candle yields. And that is a bearish outside candle. All right, now this could be very good. So let's go back and look at it and see again what happens with this trade. So again, we'll put a little box here to represent buyers and sellers. And this time I'm not going to put the numbers in. We'll just know this is an area Let me mark this. So this is going to be a strong supply area. All right, but there's breakout traders trying to trade this. So when they see this, let's see how this goes. So already there's a bunch of traders that are looking to go short because we see the market to start to come down, but there's still a bunch of traders that are on the trend that had developed, and there's a bunch that are looking to trade this breakout level. All right, so then the market hangs around here for a while, doesn't do much, and it looks like it's dropping. But then the breakout traders get very excited. They get very excited. They see the market move up like this. So now there's tons of breakout traders jumping in the market here, but there's more sellers in the market here. So there's a bunch of buy orders jumping in the market here. So there could be, at this level here, there might be more buy orders. All right, so let's say below this line there's more buy orders below this level. All this is more buy orders, but here up here there's even more sell orders that outweigh the buy orders, which causes that market to spike like it has and then drop like it does. All right, so then I'm messing myself up here. I keep hitting duplicate delete. Okay, so we want to delete these lines. But anyway, now we'll watch the market. Now all these traders that were going long, they may still be holding on, and they still might be holding on, but they're starting to get scared, and a lot of them are starting to drop off. And now you can see how much selling pressure is here as this market drops off big supply level. The market drops, and then these traders have to get rid of their trades that got caught up here. So this again, classic bull trap. That's a bull trap. Caught the bulls going long on breakout trades, and then the market just dropped. The high was higher than the previous candle, and the low is lower than the previous candle. We're in the trade right here. I would take this trade because it's not that big of a candle as opposed to the previous candle that we saw on the bullish trade. And my stop loss would be up here. All right, so now you would take that trade. Now you want to look for where your first levels, target levels are. First, I'm going to look for this level right here for profit target. All right, and I'm going to see if I can get through that level. So let's see what the market does. And it looks like it's stalling at this level. And now I could do a couple things. I could wait, or else I could move tight. So I like to move tight when I see a lot of indecision like that. But then I see this breakdown here. So I'm going to leave my stop loss there. So my next level where I would look for profit would be here. So supposedly looks like we may violate this support level. And then we want to look to see if we can make it to this level now. We have our stop loss here. We had a good entry here. And now the market almost attempted to come and take me out. But then it came down and hit my level. So now what I do, we hit our level. I don't have to take profit yet. I can move my stop loss a little bit above that level and see if the market can continue to go to the downside. And it went even farther. So now I'm in a trade from this point. I have great profit already, so I can move my stop loss here. So the market has to come back and take me out if it wanted to, and it did. And then it really doesn't look like it knows what it wants to do here. So we're out of the trade, but you could see that was a great trade. That would be your classic bearish outside candle trade off of resistance. You can see how the bulls got trapped. Bulls got trapped up in this area. There was more selling pressure, bigger supply. The market drops. Boom. You find your levels. Always look to your left to find your levels. All right. So that's what we looked at. Strong bearish, very strong bearish outside trade here. Next thing we're going to look at, guys, is inside out trading. So we're going to look at first what an inside candle is, and then we're going to look at inside out trading, because I'll show you when we get started with our inside out trading that most of the time we're not even going to really have to look for a lot of these patterns, because we're going to be trading in a box. And once the market drops outside of that box or above that box, that's where we want to get our trade. But that box has to consist of the highest high and low, and then there has to be some candles within that box. And then once we have that, then we decide which way is the trade. The trade is going to be with the trend, with the strength of the market. A lot of times when you get a candles boxed in, those candles are just basically consolidation and profit taking, stuff like that. All right, so we want to make profit on consolidation and indecision, because eventually the market has to go one way or the other, and we want to be prepared for that. So that's what we have here. We're going to move on and get to the inside out trading. Okay, so we're going to start with learning how to trade inside out. This is what we call an inside out trade. But before we do that, we have to understand what an inside candle is. So basically it's a candle that's trading within the range of the previous candle. All right, so we'll look at it here. As you can see, the market comes down and hits support here. Then you have another candle. This candle's range just is almost inside of the next candle's range, the previous candle's range, but the only thing is this wick is a little lower. So I mean, I would probably still look at it as inside, but I'm going to give you a better example. The market bounces off of that support level. Now the market's continuing to move higher. All right, then you could see this candle here. This little red candle is trading inside of this big candle, but I'm not looking for such a big range like that, so we'll look for something else. You could see these candles here, this green candle, these two candles traded inside of that candle. All right, because they never, none of their high or low wasn't higher or lower than this candle. So then we had an inside candle here, because we have our previous candle range from the low to the high. The next candle, high and low, are within this candle. So you could see we're trading inside. So here's where we start to lose that concept about having to understand all of those patterns we talked about. because once you see inside trading like this, when a candle's trading inside of another candle, this is where you're going to start getting interested in the market. So I see the market bounced off of support, then went higher and had a pullback. All right, so a little later we'll start learning and talking about the 1 2 3 pattern, but we're not going to discuss that really right now. But that's kind of what we have here. So thinking about which way the market direction is, and looking at fractals and all of that, I see that I'm going to box this market in. So when I box it in, it's boxed in because one candle is trading, at least one candle is trading inside of this big candle here. So what am I'm going to be looking for a bullish breakout of this. This is going to be a bullish inside out trading opportunity because I'm expecting the market to go higher. So we talked about these formations. One of them was the 3 inside up. Okay, so currently this is setting up to be a 3 inside up. So let's see what the next candle does. The next candle breaks outside of that level. All right, so that's a 3 inside up. So you would put your entry right there and trade to the upside. All right, but that's what a 3 inside up. We're not looking at 3 inside up. So what we're looking at now is inside out trading. So you don't even have to know that was a 3 inside up, because you're going to trade it basically the exact same way. You're going to look for inside trading, and then you're going to trade the outside once it breaks outside of that inside of the other candle. So there's a couple ways I can do this, and I'm going to show you an aggressive setup. The aggressive trader is going to put an entry level probably a couple pips above, because the market always likes to come up to these points and then bounce around. And then we're going to make our entry, our pending order is going to be a green line. So that's a pending order. And this is going to be an aggressive entry. You have to start out with your stop loss. You have to start it with down here. So we'll make it red to represent the stop loss. Okay, so just looking at that, we already know where we want to enter the market. We're going to adjust everything once we see what the market does, but we already know where our entry is. So this is going to be an aggressive entry. All right, so once we get a candle that violates, we're in the trade right here. It just has to break that level or touch that level, and it triggers our trade to the upside. All right, so the trade would have never triggered if the market would have came down and went lower. All right, but the market didn't. So a lot of times what I'm looking at is this. Let's mark this. So if the market would have came down, bounced around in here, and then closed outside of here, I would have taken everything off the table. I would have never even thought about taking the trade. You take the box off and everything's off the table. But being as the trade broke to the upside, this is a bullish inside out trade. This is where our entry is right here. All right, so our stop loss was here. We're going to be with an aggressive stop loss. We're going to put it up at the candle that violated. So here's the candle that violated. So you could see this was the same pattern as a 3 inside up, and if it was a 3 inside down, it'd be the exact same thing. So with a lot of these patterns, you're going to get the same thing. I mean, if I had a Pearson line pattern, I can get in a little sooner, because this is pretty much a Pearson line pattern here, and I'd be able to take that trade. But I probably wouldn't take the trade in the environment that it is. I'd like to see levels getting broken. That's why we trade the breaking of the high level or the low level, because trading inside of these candles here, you know, you can range for a while. The market can come down, pierce you, then come back up. So it's not a environment where, you know, everything is stable for you. You want to make sure you start breaking levels before you really get into a trade, because when the market's moving higher, you're breaking these highs, right? But when it's when we're moving lower, we're breaking these lows. If you don't do that, then you're ranging, or else you're going to reverse the other way. So to be sure, not even sure, this isn't even 100% confirmation, but it gives you a little bit higher probability if you close above this high or break above this high, and we enter the market there. All right, so now we moved our stop loss up to this point, and so let's see what this market does. And this market takes off, gives us a good trade. And then now here, here's where I get worried when I see a little bit of indecision here, and I kind of move my stop loss. I tell you, we followed 2 candles behind. We would have been way back here. But when I see this kind of indecision, I start moving my stop loss up there. And then it triggered me. I'm out of the trade. And you can see the market drop. You see all these little candles, like this is pretty much indecision, consolidation. This is a little bit more consolidation, but then you could see the market drop. But we made profit on an inside out trade. First we saw the concept of one candle trading inside of another, so we would call this the mother bar, and then this candle was trading inside of that candle. So the mother bar has a baby in there. The mother bar is pregnant with a baby. There could be twins in there, there could be triplets or whatever. It doesn't matter how many. It could go all the way to the end of this box here. You could have candles trading inside of that one candle. But once it breaks out either way, that's the direction we want to be going. Now, we don't want to go if it breaks to the bottom, because if we're trading in a market that's moving to the upside, then we're looking for a bullish breakout to the upside. If the market breaks to the downside and closes, then we just get the box off the table. All right. So that's looking at inside out trading. We're going to look at a couple more examples, because this is going to be one of the biggest concepts that we use, is this inside out trading. All right, so let's look at a few more examples. All right, so previously we looked at this candle here, and this was a bearish outside candle. So we looked at it as a bearish outside candle. All right, but also if you watch this market move on, this is an inside candle. Now this candle is trading inside of this bearish outside candle. So now this candle is trading inside the bearish outside candle. Therefore, we have inside trading. All right. So when we see a candle trading inside of another candle, and now we're looking to trade to the downside because we hit resistance. All right. So we always box the market in, and then we're looking to trade outside. So that's why we call it inside out. All right. And this here would be considered a big mother bar, as you have babies inside of the mother. So each candle inside of here would be considered a little baby inside of there, and we can have as many as possible in there. It could be 1, 5, 7, 10, whatever. All right. So I just looked at one where there's 16 in action right now in a true market, and I'll show you guys that. But when we see this, we box the market in. Now there's 2 ways to trade this. Again, you could trade it. We're trading inside out. You could set an entry order here. This is going to be your aggressive entry. All right, and we could do that. We do this in the trend. We do this everywhere. All right, so this is going to be your aggressive entry, and then your stop loss is going to be right here where this candle is, right here. All right, but I usually like to start out with this level. But really, if the market's going to come back and take you out here, then the trend is not ready to move. All right, and you don't have the momentum to sustain that move, so you probably wouldn't want to be in that trade anyway. So let's see what goes on. Then the market drops like crazy. So now I'm going to move my stop loss at least to break even, right? So we'll move it to break even. We'll take a little bit more profit. Then you see the market dropping lower. And as it dropped lower, it looked like it lost some momentum and got a little weaker. So the next candle traded inside of this candle. So this candle is engulfing this candle. So now we want to trade that. So we look at that, and you can see what we have here. So we're looking at this candle here, starting here, and we're trading inside here. So the market was moving to the downside. We're looking for a bearish breakout. If it breaks out to the upside and closes, then we just take this off the table. So then the next candle breaks outside. My stop loss would have been up here because that's the candle that broke. So we break now, and then we see where the market goes, and you made some good profit. You look to take your real profit at this level here, because this is your support and resistance level right here. So you've reached that level. Even if you started from this point, you look to take profit here, and you've reached that level. All right, because we always look to our left for the support and resistance levels, and that's where we want to take our profit. So we violated this level here, and so we're going to keep trading. All right, see what the market does. And now we're still looking to trade inside, right? But we always have a support and resistance level that we're looking to take our trade. So if we're moving to the downside and we violated this support, it's now resistance. We're looking to trade to the downside off of resistance. So the market gives us a candle, and this right here, you could really pretty much look at this and say it has a higher high and a lower low. You would call it an outside candle. I'm not going to call it that because it has no body. It's an indecision candle. And it's not it's rejection. It would have been rejection if it was on the upper side here, but it's not rejection here pretty much. So then now you do have what we call this a shooting star, all right, because you could see we have this long wick. So how do we trade a shooting star? So trading throughout this time, we've just crossed over two of the patterns we talked about. We're going to enter when the market breaks this level. We're not going to wait for the close. We're going to trade it aggressive and trade the break. Our stop loss will be up here. So we get a break. If we would have waited, we would have closed way down here. We took the break, and that limits our risk. We only have to risk this much. Now if we wait here, our risk has to be way up here. So we took this trade and we did well in this trade. So it looks like we're doing pretty decent for the trade setups that I'm showing you. Basically, I wanted to show you the inside out, but in the process, you could see we keep trading support and resistance levels and moving to the downside. So that's really your inside out trade. I'm going to show you some more, and then we'll look at some real charts that are live time right now and see if we see any inside out trade opportunities there and what I'm going to do and how I'm going to set it up. All right, so let's look at something else in context. Okay, so I want you to pick up on this concept of inside out trading because I think it's going to be just something that you could really rely on. I mean, it's something that I use all the time, and also it's going to help you to eliminate having to know all of those patterns that we just looked at. All right, so it'll eliminate that because you're going to be trading half of those patterns just by trading inside out as I'm showing you here. But let's look at this market and what it is context here. Now I'm not boxing this market in, but in reality I am. I'm not trading this box, so I'm just letting you see we're in a range here. So this market was in a range right here. So we want to see what the market does. It breaks outside of that range. It looks kind of iffy to take a trade here to the downside because a lot of times these markets fade the breakout, so it'll break out and then pull back in, and it's showing like it's rejecting the prices, the lower prices. But then if you see this candle is this here candle is trading inside of this candle, so definitely I'm interested in trading this. So now I'm just going to watch the market, and it breaks out and closes below. I'm in the trade right here. My stop loss is up above the box here. So we're in this trade. We take this trade to the downside right here. Okay, so you see we broke out and looks like the market's moving down. Our next target is going to be the support and resistance level. Most likely that's where we would shoot for our target. So we just watched the market, and we're going to remove some of these boxes. But if we even removing this box, you could see we're inside again. So you see we're trading inside again, and now we still have another candle inside. So we got two candles inside. This is not really even a candle. It's nothing really. No, lot of indecision with that candle. And then the market drops to the downside way down here. This must have been a close on Friday. What you had here was a close on Friday, then the market dropped down, so we're in profit. The market moves a little lower, and then we just watch to see where the market goes. And you're trading inside here again, but I don't think I would mess with this trade because we're really close to the support and resistance level, and we're a little bit above that wick. So I wouldn't even really look at that because we're really close to the support and resistance level. See what the market does. And then the market finds that support and resistance level here after we came from the trade to this downside here. So you could see how I got into two opportunities just between this point here, which would have gave me an opportunity to catch this trend to the downside. So basically, there's no set crazy rules that you're going to be following. You're just going to be looking at price action and observing. But some rules that you will want to follow is a lot of times, you know, when I'm looking at these trades, if the market breaks and closes below the opposite direction of the trend, then I don't take the trade because I'm trying to trade with the trend. So if I get an inside out here, so basically what we want to do, once we see that we're trading inside out right here, or we're trading inside right here, if the market comes up and closes above your box, then you're done. You take that box off, delete the box, and then move on for the next opportunity. All right. So you don't want the market to close in the opposite direction, or else you take that off the table and you look for something else. All right. And you could set your trades up as far as, you know, the conservative entry or the aggressive entry as shown. So let me make sure you're clear with that. So this is really close, so it wouldn't really matter, but the conservative entry would be to take the trade down here once the candle closed outside of this box. But the aggressive entry is going to be at the box, so you already put a pending order once you have inside trading inside that box, and then the market breaks, it triggers you already. Your conservative stop loss is going to be at the box, at the bottom of the box or the top of the box, depending on the direction you're trading. But your conservative stop loss will be on the candle that violates the box. All right, your aggressive stop loss will be on the candle that violates the box. All right, so that's what we're looking at when I'm talking about inside out trading. It's going to be a major concept. You guys are going to be able to come into the forum, and we have a lot of discussions about inside out trading and things of that nature. So I'm going to take you to some charts, and we'll look at some live charts in context, and I'll look at some where we see some inside out trading. All right, so let's continue to move on. Okay, so currently this is the live market here. This is the US dollar CAD, and the way I box this in, because it has an opportunity to be boxed in, first of all, it's boxed in right here. But I would look to box this candle in, and I probably wouldn't want to box the biggest candle in, but you do have to get outside of that range. I would look to box this in, and we're trading to the upside. The market's moving to the upside, so we want to trade it to the upside. So we would look for a bullish break of this box right here. Now, we're not boxed in with this yet until this candle closed inside of this candle. That's what I would be looking for there. Okay, but here we are boxed in here currently. So basically we can see this level. We really want to violate that level to the upside, and we trade to the upside. So that's boxed in there. All right, so let's look at a couple more. This is the Aussie yen. I had this whole boxed in, but this is kind of big. I don't really want to look for a box that big. Here you go, is something like this. All right, so this was boxed in. You could see this candle was trading inside of this candle, and then the market blew to the downside. All right, it didn't blow to the downside, but it broke to the downside. You could have put an entry here, or you put your entry where the candle closed. But then again, it's giving you another inside trade opportunity. So we're inside of this candle, and then we want to see what's going to happen here. Okay, so I got the market boxed in. It has to go one way or the other, right? So you can see we're boxed in here. This is currently where the market is. And if it violates that level, then we move to the into the trade to the downside. If it violates to the upside, we're not trading to the upside. We don't want to trade to the upside, so we'll let that go, because it could be just a false break or whatever. You know, even if it does close, we want to trade the direction of the trend until we get a change over of our pretty much of our fractal levels. So let's look at another opportunity. Okay, so this Euro Aussie, it's kind of spiky, so I really don't like it that much, but I'm going to show you. You can also box this in at the current time here. Basically, we could box it in with this candle, the red candle, but I would go to the green candle because it's so close. So I want to see, I'm boxing everything in with this green candle. I want to see a close above this level. If this current candle comes down and closes below the level, then my box is off the table, and we look for something else. All right, so we'll move on, look at a couple other pairs. So this euro pound, you could see starting here, this market could have been boxed in so many times, it's not funny. But here I would have looked and I would have saw this candle trading inside these two candles, because none really closed below the close of this candle, so we didn't get a lower close. We did get a lower low here, but I'm looking at this lower close. I would have boxed these two in, and then it would have became a third candle, and I would have kept this on the table. This is a good opportunity for you to look, because what I'm looking at here, guys, when we get the really small candles like this, this represents major consolidation. All right, and we want some consolidation in a trend, because when we get that consolidation, then we know that it's going to break out eventually. So we had inside trading here, but then we had a big candle blow above that level and then close. I wouldn't have taken this off the table. It closed back inside of this box. All right, and then it's also a rejection of the upper level, and then the market stayed inside here and then finally blew out to the downside. All right, now you could have put an entry in here and with a stop loss up here, but the market blew down. If you would have put your entry here at the market close, you would have had your stop loss up here, but you're still into a good trade, and then you're going to continue on. Then the market does the same thing again. It has to rest after that big move, so it consolidates a little. You get some traders that are taking profit and whatnot. So we're trading inside here, then we break out. We could have put our entry here, or we could enter here. So the market breaks out. The stop loss could be here, or it could be there. All right, and then we get another opportunity. Again, the market's trading inside on this candle. So now currently we're trading inside on this candle. All we have to do is sit here and wait, see which way the market's going to close. If it closes below, we're going to take the trade to the downside. All right, we're following that trend every time. When the trend exhausts itself and takes a little rest with that consolidation here, and then moves back to the downside. All right, so that's looking at how we can find opportunities in the live current markets. Let's look at a couple more opportunities. So I'm looking at the Euro New Zealand dollar. This is one that I wouldn't trade much often because it spikes a lot. But when the market was here, you had a chance to box this market in, and it's still inside the box pretty much 16 candles later or so, somewhere in there. But you could see what we have here. We're looking to trade to the downside, so you see we would have started with this candle, then we have 3, 4, 5, 6. 16 candles inside of one candle pretty much. I mean, we had a break here with a little violation, but we didn't close above. So I would have still kept this on, because if it would have closed above here, then I would have taken it off. But currently, if we close below this level here, then I'm looking to trade this to the downside. If it closes above, then I probably take the trade off the table. But you can see how many candles are inside of this one candle. So it doesn't have to be just 1, 2, 3 or so. This one is 15 candles inside of one. All right, so let's look at another opportunity. All right, so this is the Euro US dollar 4-hour time frame. There's a bunch of opportunities to box this market in, especially when you get this, but there was opportunities here. Okay, so we'll look at them really quick, and then we'll look at the current opportunity. You could box this market in right here. Okay, then you got a big close, probably bigger than you want, so you probably don't take that. And then I'm not going to really box this one in, because this is a great box to be in, but this candle's too big. I would love a candle like this and then have these smaller candles, because that's really true consolidation there. But now you're looking at where the market is currently. So this is where we are currently. We're inside of this one candle. If we can close below this level, we'll trade that to the downside and we'll continue to follow the market trend just like this. All right, so let's look at something else. This is Euro US dollar 4-hour time frame. Let's move on to something else. Okay, so currently this pound yen, there's a current inside opportunity, because we're right here. Now, the thing about this one, I don't believe this one's going to go to our direction. All right, so what it would have to do, we want to see the market close above this level. If it doesn't and closes below, then we take this off the table. But currently we're trading inside here with three candles inside so far. So that's a good, maybe a good opportunity. If the market consolidates and stays in this area for a while, maybe ranges for a little bit, then you'll get that breakout to the upside. Now, I'm not trading true range. We're not really boxing the market in as a range per se. We're boxing in a little consolidation basically. All right, or we're just boxing in highs and lows. A big range, let's say this is a range. I don't want to trade range breakouts because they fail a lot, but this isn't really a good range to show you. But a lot of times we have market bouncing on these ranges and then they fail to break, and I don't like to trade those. You know, you get a lot of false breaks. I think you lose a lot of money in breakout trading like that. Okay, so that's looking at the pound yen. We're going to look at one more opportunity here and then we'll close out and continue with our next section. Okay, so the US dollar yen 4-hour time frame, the big picture here, we could box this whole thing in here, but I don't want to be boxing these huge candles in. I don't want to give the market that much of a range to go against me, so I want to box in normal size candles. What's pretty normal for this pair if you look at? So yeah, that would be pretty normal, but if the smaller the candles, a little bit better. So like half of that, you know, but even that would be a good box, because if the market closes above that level, I'm taking the trade. All right, but while it's inside here, it's been in here for a few candles. You did break here, but I want to see a close if I'm going to take it off the table, really. Okay, and if you would have taken this trade on just the aggressive entry, you would have been stuck with a bad trade right now, and you would have been probably taken out, because let me show you. All right, so this aggressive entry here, you would have been right here. You entered here with an aggressive entry. So we'll make that a dashed line so we know what it is. That's our aggressive entry right there. And then we'll probably put a stop right here, be aggressive with it. All right, so if we put our stop there, you could see the market triggered you, came back and stayed inside this box and then took you out. Now, if you would have entered here and then had a bigger stop loss, because you're going to come down to the box now, I really wouldn't want to have that big of a stop loss. The market triggers you, and then now you're sitting in a losing trade right now. You have to wait to see if it can climb back up and break out of that box. And meanwhile, it's approaching closer to your stop loss. You have a bigger risk, so bigger opportunity for you to lose more pips, more of your account rather, where you're risking more of your account. So I do like to be with the aggressive stop loss, but the aggressive entry isn't always the best. But you could see, even with the aggressive entry, you would have lost less pips. You wouldn't have had much of a loss here. Now, if the candle closed up here and then came back, your risk is getting bigger, but your aggressive stop loss is helping you a little bit. So you see, the aggressive entry, it's going to be a personal thing, and you know, it has to be sometime a feel for the market or how you feel about that opportunity. It has to be a feel thing and a personal thing, so you have to decide if you want to do aggressive entry or a conservative entry. A lot of times the conservative entry confirms that you're trading outside of that range now, or outside of that inside out pattern. So if you don't get the confirmation, then a lot of times you get the market falling back in. But even when you do get the confirmation, the market still can drop in and still take you out. All right, so there's no, like I said, no foolproof trading, but there's things that we just talked about that are high probability trading setups that are going to help you out a lot. So this is pretty much going to be it, showing the examples here on the live market. So guys, we're going to probably end up moving on to the next section here and looking for the market structure, and that's going to really help you guys out. So that's it for these trading setups.
Train your eyes to see these price action patterns. Conclusion. Well, we have come to the end of the first section of the price action course, and you have learned some basic candlestick patterns and how to trade these patterns. We still have a lot more information to cover, such as market structure and support and resistance. along with some rules that we need to focus on to help us to look for the highest probability trading opportunities. For now, you will need to make sure you understand what we already covered because you have a quiz to take. So once you take the quiz, you can move on to the next section. Should you fail the quiz, then you will have to take it over and pass before you can move on. See you in the next section and good luck.